Sports car maker Porsche. Renault posts a record loss as the car maker warns of a difficult year ahead. And NatWest resumes its dividend as Britain's biggest corporate lender winds down its Irish business after more than 150 years. We're going to hear from the group's CFO shortly. Right now, I want to take a look at, well, futures. European futures are actually headed higher, even as we say global stocks are down. Not the case, really, in Europe, although there's not a heck of a lot of size there. Take a look at the global macro movers screen. This shows you a number of risk assets across the columns. The far left-hand column, of course, the equity indexes, and it will populate as they open up to trade. The FTSE, always the first out of the gate, doing almost nothing right now. The IBEX 35 up in Madrid, about 0.1% as it opens up. The CAC 40 in Paris opens up 1 to 0.2% this morning. So we're seeing basically not a lot going on in equities in the UK. There is some other pretty interesting news in terms of UK risk assets, and I'll get to that in a second. But we do see continental equity indexes open up higher. That's as investors mull the impact of the recent climb in treasury yields and then drop again. We have a great guest to talk about that climb and drop, that movement, and what kind of volatility we can expect going forward. Stephen Major joins us, HSBC Global Head of Fixed Income Research. Stephen, before I get to fixed income, I just want to point out the cable rate. We're almost at $1.40 for a pound right now, looking at, I think, 139.87, and we can bring it up here on the screen to see what it is live. What do you think about the strength, well, either the strength of sterling or the weakness in the dollar?
You're quite right, Matt. It could be a combination of both, couldn't it? Most people, I think, will recognize that the UK, perhaps rather through luck than judgment, seems to be bouncing a bit better than other parts of Europe. That may be one of the reasons. I also think that the tail risk of negative rates was pretty much taken off the table a week or so ago. And that's helped if you think about the possible scenarios that might be there for rates in the future. So there's a few things underpinning that sterling rally. I'm not the FX guy, but clearly there's been some upside surprise in the data and in the rate outlook, and it's all relative to the US and Europe.
You're not the FX guy, but of course it touches all the, it touches everything that you deal with. I mean, you point out negative rates affects the currencies, and the possibility of that, of course, affects your world even more seriously. Is it off the table? Is it no longer something that that investors in gilts have to worry about?
Well, it's definitely not off the table forever. It's off the table for now, perhaps for this cycle. And that's a very important thing to point out. So I'm glad you've gone there. We have negative real rates at the short maturities of minus 200 in the US and Europe, nearly minus 300 in the UK. That's a function of rates being trapped close to zero, projected to be at zero because of forward guidance and QE, etc. And then when you get the rising inflation risk premia and some rising inflation expectations, then that pushes the real yield down. It's the only way it can go. The fact that the real yields are so deeply negative just tells you that markets function okay with negative rates. It's just a question of time before we get nominal rates going negative in some parts of the world. You could see it soon in the US, by the way, market rates, not official rates, market rates, because of the technicalities in the money market at the moment. There's just so much collateral around, and it's really pushing the yield down. As you've probably seen, short-dated yields in the US have been going down whilst there's been upward pressure elsewhere on the curve.
And you don't think that's going to cause a problem in the economy, in the markets?
Well, there's something interesting happening, Matt, and you can look through fixed income at things like those short yields going down so much at the moment, the possibility that you could see market yields going below zero, the cheapness of off-the-run bonds versus on-the-runs, the movements in the bonds versus swaps. There's a bunch of things that are red flags to me, and they're saying something is cooking in the system. And I know risk assets have been only going up. Everything's been going up, but there's something cooking under the surface.
Yeah, actually, our Abigail Doolittle, who watches stocks for us in the U.S., had a chart the other day showing that as we see the yield curve steepen, when it steepens more quickly, then you start to see the S&P 500 get volatile or maybe even correct. Actually, here's the chart. Hillary just brought it up, 1449. Why is that, you think, when this is the twos, tens, why is it when the yield curve steepens, it tends to kind of freak out people in risk assets?
I guess it depends what kind of steepening it is. If it's benign, then it should be good for some sectors of the stock market. Clearly, it's good for banks who can lend at a higher rate and borrow at a lower one. In theory, at least, the steep yield curve should work for banks. But if it's fast and disruptive, then it starts to mess up investment plans, and it might start to disrupt some of the assumptions in equities and credit. You know, for example, much of the valuation in the equity market is premised on very low real rates for a very long time. Now, as you can see from the yield curve, the real rates are low at the long end and they haven't really moved. The only action is at the front end where they've been diving lower. So to me, there's a bit of a false signal being given by the bond market. You know, maybe the yield curve steepening is mainly a function of inflation risk premium. You should know this. It isn't actual inflation. It's the fact that the oil price went up compared to last year, and the risk premium around future inflation has zoomed up. By the way, the risk premium is a measure of uncertainty. That means it could go up or down. We just don't know. But it's not the same thing as actual inflation. So what the yield curve is telling you is it doesn't know. It's unsure. It's possible that the huge policy mix experiment might start to have some impact. It could be disruptive. That's how I read it anyway.
So is that kind of uncertainty, when you say something's cooking, right? Something's happening, something's bubbling under the surface. Do you have an idea as to what that could be, or do you have that same kind of uncertainty as well?
Well, I've written about it. I called it beneath the surface, and that's the bubbling under, the cooking thing. And it refers to what's going on with short-dated real yields. They've been going down to deeply negative levels. So US short-dated real yields are minus 200 when they were plus 100 only a year and a half ago. That's quite some move. In fact, they're minus 200 in Europe as well. Does that mean it's stimulative? Is that a reason to take risk, or is that the sign of something else? You see, I think we could be seeing the latter stages of some speculative activity. And again, think about what's happening in the alternatives, in Bitcoin, and what's happened with Reddit, and the fact that everyone's looking over their shoulder, just checking what's going on here. It seems to me that something is happening. By definition, you don't know until afterwards. But there's a lot of red flags in the bond market. And I went through the list just now. Look at the bond swap spreads. Look at the on-the-run, off-the-run. Look at the curve. Look at the long-dated real yield compared to the short-dated. Lots of stuff happening. Meanwhile, the bond market has repriced so that yields have gone back to where they were pre-pandemic. That's government bonds. Credit is still tight, and equities are flying. So you can take your pick from that. The bond market has repriced to pre-pandemic.
Yeah, no, I think it's something that's apparent to a lot of market participants, but many don't know what to do about it. John Authers wrote a column the other day, and he says one of the last thing any investor should do is try to time a bubble, but when a bubble is upon you, you don't have much choice. And I think that's interesting. It's illustrative of the position a lot of people have. Like, what can they do? Stephen, we're going to hold you with us for a little bit longer. Stephen Major, HSBC Global Head of Fixed Income Research, with a truly important conversation about what's going on right now, as Tom Keene would say, the zeitgeist in these markets. Coming up, NatWest resumes its dividend as the lender exits its Irish business after 1.5 centuries there. We're going to hear from the CFO, Katie Murray, next. This is Bloomberg. Welcome back to Bloomberg Markets. This is the European Open. We are 13 minutes into the trading session. Here you see the equity indexes. Right now, the FTSE is down a little bit, but for an important reason that I'm going to show you in just a moment, we have the DAX gaining almost 1/3 of 1%, the CAC 40 gaining a little bit more than 1/4 of 1%. But what I really want to do is take a look at cable, and I'm not sure if Hillary can pull up the pound for us here, but we're getting ever closer to $1.40. So, I've got the GIP open on my screen because I want to see if it gets there. It's obviously, well, maybe not obviously, but it is, I believe, a fairly meaningless number, just that it's a little bit round, so it's easier to remember. There you see the GIP on Hillary's Bloomberg terminal. 139.89 is where we're trading, or what the high has been, I should say. Right now we're trading at 139.82. But definitely something that you want to keep your eye on. The other thing you want to keep your eye on is the U.S. Treasury yield right now at 130.08. So 1.3008. I think the Treasury yield, now just ticked below 130. But it's interesting to watch this because it affects so many assets, as we were just talking to Stephen Major about. When we see treasuries rise, the yield makes other things, for example, gold, which doesn't yield anything, a little bit less attractive. That's why you see gold trading down at 1773. Let's get the Bloomberg Business Flash right now. For that, we go to Laura Wright in London. Laura?
Thanks, Matt. Deutsche Bank is scaling back plans for its bonus pool after the European Central Bank objected to the level of payouts. Bloomberg sources say Germany's largest lender initially planned to pay out more than 2 billion euros for staff performance in 2020, but that amount has been cut after talks with the regulator. No comment from either Deutsche Bank or the ECB. Credit Suisse is looking to gain full control over its securities venture in China. It plans to double its headcount and revenue in the world's fastest growing major economy. Last year, the Swiss firm gained majority control over the business and has been working to upgrade its infrastructure and move more bankers into China. That's your Bloomberg Business Flash. Matt.
Laura, thanks very much. Laura right there in London with your Business Flash. Now, NatWest is resuming its dividend and setting new targets after earnings in the fourth quarter beat estimates. Britain's biggest corporate lender will also exit Ulster Bank, its 150-year-old Irish unit, which has underperformed since the financial crisis. We spoke to the lender's CFO, Katie Murray, about the decision to wind down the division.
And we've very much concluded it's not going to be possible to make an acceptable return over our planning horizon. So we've entered into a non-binding agreement this morning with AIB in terms of the sale of some of our loans. And we're also continuing in other conversations with other strategic partners. So the reality is, as I'm sure you're aware, that the exit of a bank takes time. And so it will be a number of years before we fully exit from Ireland. And I think it's important that we do it in a managed way, very much to look after our customers and our colleagues over there.
And talking of looking after your colleagues, what kind of job losses do you envisage this meaning?
So what we've said is to our colleagues there that there'll be no redundancies this year. There'll be no branch closures. That gives us time to kind of work through. What's exciting about some of the conversations that we're having is they're very interested in taking the people who service these customers with them. So at this stage, it's relatively hard to give you an actual number. And certainly within the NatWest Group, what we always say is that we'll talk to our colleagues first before we talk to external around numbers. But I think it's important for us to try to get the best solution for our colleagues and our customers.
You must also have been talking with the Irish government about this, though, as well. How are they taking it?
No, I think the Irish government's always been very open about their desire to create a third force, and we'll continue to work with them very, very positively as we work through this.
What will this allow NatWest to do? Obviously, the capital requirements in Ireland very, very high. Exiting this business, how will that allow NatWest to do different things?
We've given our return on tangible equity targets of 9 to 10%. This entity is one that we don't believe could ever get to that level of return. So therefore, it's a drag on the group and it consumes capital at a return that we don't feel is appropriate from a financial perspective. So what it will do is it'll free up some of that capital to allow us either to return it to our shareholders or to invest further in the group to make sure that we can maintain and deliver a strong, sustainable return to our wider stakeholder base.
NatWest, of course, transitioning to be an ever more retail-focused bank. You've been benefiting from a strong mortgage market, but of course, interest rates are very low. What do you think when we hear from the Bank of England that banks need to be prepared for negative rates?
So we're a strong retail bank. I think it's our area where we see some of the most positive growth. We're obviously a very large commercial bank as well. You know, when we look at negative rates, it's not something that's in our scenarios. It's not something we believe that will come. We believe it's absolutely the right question for the bank to have asked all of the financial institutions in the UK. So if we go negative, it is a policy toolkit kind of item. Can you cope with it? And that's really what they've done. But at the moment, if I look at consensus in the market today, if I look at some of the comments from the Bank of England as well, it's not something that we believe is coming. But if it does come, we'll be able to deal with it from an administrative perspective. Obviously, for a bank, it's quite impactful on your returns. And we can see that particularly in some of our European counterparts.
So more digital banking for NatWest streamlining as well, as we've heard, divesting Ulster, also looking at other parts of the business. Where do you see NatWest in the next few years? Are you going to be in a position to engage in some kind of M&A?
M&A is something we always look at. We made a small acquisition at the tail end of last year. We bought £3 billion of Metrobank's mortgage book. So what we always say on M&A is that if it's something that can add appropriate volume to us, because we do have capacity to grow in quite a number of our areas, or it can add real capability that we don't have, it's something that we look at. It's not the top priority of the group, but it's something that we're active in, and it was very nice to get the Metrobank transaction through just at the tail end of next year. But in terms of the future, very, very focused on our 9 to 10% ROTE challenges that we're coming to, and this return back to our shareholders of the excess capital.
And that was the CFO of NatWest, Katie Murray there, speaking to Bloomberg's Emma Chandra. I want to stick with the UK for a moment with Stephen Major, HSBC Global Head of Fixed Income Research, now in Hong Kong, Stephen, but of course, you still pay close attention to your home market. What do you make of the speed of the vaccinations in the UK? It's relative to what we're seeing here in Europe, astoundingly quick, and the effect that has on the economy.
Well, I think in the earlier segment, I said whether it's by accident or by design.
Yes, you did.
It's good news. And clearly there's a race to get to this herd immunity or the required level of vaccination. And then maybe things open up. And I guess markets are pricing according to that timing. And that's something that the UK has a head start on at this point. So I think that's something that in the Bank of England's eyes is a positive, and therefore when they look at all of the possible scenarios, the plausible outcomes, that they're adjusting them, and you can see that the gilt market has repriced. It's repriced because again the probability of negative rates happening sometime soon has been reduced dramatically. It might come back again later, but it's been reduced for now. And so the gilt curve, the shape of it, looks a lot more like other markets now. It's not as steep or as high as the Treasury yield, but it's looking a lot more normal. And that's a reflection of a positive outlook, a view that things are going to get much better.
All right, Stephen, we're going to keep you for a little bit longer. Stephen Major, HSBC Global Head of Fixed Income Research, stays with us. Coming up, the conversation moves to Europe. This is Bloomberg. Stephen Major, HSBC Global Head of Fixed Income Research, is still with us. And I said we wanted to get to Europe. We talked a little bit about the reflation, especially in the U.S. and what it is, Stephen. And actually, James Harai wrote a column for Bloomberg, I guess 2 days ago. The headline, or the first line is, Europe is getting left in the dust like never before by the reflation frenzy across the Atlantic. What do you think about that from the standpoint of Europe?
Well, you can see it in the U.S. curve is steep compared to the Bund curve. It's a record steepness. The break-even spreads have widened by more in the U.S. than in Europe. So the reflation trade is moving much faster in the U.S. So all of that's true, and I think it gives me this idea that maybe the Eurozone inflation expectations and risk premia that have been building up is mainly due to what's happening in the US. Now, fundamentally, I would say that the least chance of inflation taking off is in the Eurozone. So for investors looking to position, there's the chance there to sell break-evens, for example, which basically means buying longer-dated nominal bonds versus the inflation-linked equivalent.
That's good, because no one hates inflation more than the Germans, Stephen. Certainly not in the Western world. Stephen Major, HSBC Global Head of Fixed Income Research. Always a pleasure having you on the program. Really look forward to having you on again, but reading more of your work in the meantime. Stephen is going to be continuing the conversation with us on Bloomberg Radio at 9 a.m. UK time. So if you are in the city of London, you can listen on DAB digital radio. Anywhere else in the world, just tune in on the internet at bloombergradio.com. welcome back to the Open. We are 30 minutes into the session right now and looking at some gains, about 1/4 to 1/3 of 1% on the continent. The FTSE actually little change right now, partially because of the strength in the pound, which is moving ever closer to $1.40. So real strength in the cable rate right now. Let's take a look at which sectors are on the move. If you look at any broader index and type GRR, you can see the group ranked return screen. Here you can see, for example, that the biggest losers today are, well, energy and utilities are down, media and healthcare are down. So you do have, along with energy, really the defensive names down. The gainers, I did the losers first because I wanted to give myself a second to try and figure out exactly what CP and S stands for. I'm going to say it's consumer products and staples. I'm not 100% sure. Recently, S&P has changed all of these categories, and at some point, Hillary's going to click in there, and we can see. If you just hold the mouse over, I can't see that. You've got to click in and then type DES go, and then we will find out exactly what it is, DES go, and then we'll see. Well, are you gonna, there you go. And it is consumer products and services. Thank you very much, Hillary Clark. Now, let's get on to the news. House Democrats sparred with the heads of Robinhood and Citadel yesterday during a financial services committee hearing over the GameStop frenzy. Lawmakers pressed the firms on whether they're profiting at the expense of retail investors and complaining that they got few satisfying answers.
This conflict of interest is in your customer's best interest, yes or no?
We've made mistakes in the past. I'm not claiming that.
Answer yes or no to that question.
The reason that
Gentlemen, can answer yes or no. I'm reclaiming my time.
What steps is your company taking to guard against this? Anything at all?
When I go to Robinhood's website and the blog post you initially released on January 28th, your financial requirements with your clearinghouse are not mentioned.
If removing the revenues that you make from a payment for order flow would cause the removal of free commissions, doesn't that mean that trading on Robinhood isn't actually free to begin with?
You are doing a great job of wasting my time. You should, if you're going to filibuster, you should run for the Senate.
All right, heated scenes there from the Financial Services Committee hearing, and it does beg the question, does everybody understand how financial markets work? Because that's not the impression that I came away with after watching that hearing yesterday. Bloomberg's Danny Berger joins us for more. So did you watch the whole hearing, Danny? I mean, it did seem like there was a lot of theater and a lot of people asking questions. Seemed like they hadn't really studied the issue quite yet.
Yeah, I did watch the whole thing, and some of the questions I have to say were kind of confusing. At one point, someone asked Led Tenef, why did you name the company Robinhood? And, you know, that was kind of an extreme example, but I feel like a lot of the questions didn't really get to the heart of the matter, which was the volatility when we saw GameStop spike and then when Robinhood had to restrict trades. It felt like a lot of sort of the questions were unable to get into the technical of that. You had some lawmakers who maybe were able to venture into the wonkiness of it, but instead it was things like, has trading become too gamified? Is the retail investor at a disadvantage to hedge funds? Which, Matt, of course they are. I mean, you're talking about professional hedge funds who have the money, who have the resources. Of course, retailers are not going to be at the same level that they are. But really, you got the sense that lawmakers thought, okay, this was a big happening, something has to be done about it. But often it felt like kind of the question went into sort of irrelevant streams of thought that didn't really have to do with the actual volatility. So we didn't get a lot of answers behind why there was the volatility. By the way, Matt, how disappointed were you that Roaring Kitty was not wearing his headband during the trial?
I was bummed. I was bummed about that, but it was great that he cleared up any confusion there might have been in stating that he was not indeed a cat. And I thought it was, yeah, you know, a lot of people, McHenry, for example, was confused about why retail investors couldn't buy shares in Robinhood, which is a private company. And you would think that he understands how the markets work and who has access to what. In any case, Keith Gill was indeed, Roaring Kitty was indeed the star of the show from my perspective. What sort of questioning did he get, and how do you think he did?
Look, he didn't get a lot of questioning. I really thought his opening remarks, which were prepared, we'd seen them before, I thought they struck this really interesting tone of saying, look, I'm just a regular guy. I'm not a hedge fund. I'm not a cat. And he talked about sort of the benefit to his family. It was actually a really sweet story. But I think one of the interesting things was when he was giving those remarks, he said, I like the stock. Again, another fantastic line from Keith Gill. And you saw a bit of a pop in GameStop. At one point, one of the lawmakers asked him if he would still buy at this point. He said, yep, I would. So I thought his commentary was really enjoyable, Matt.
I was also watching Wall Street Bets, which had some fantastic memes along with the testimony there. Danny, thanks very much. Danny Berger there, wrapping up the GameStop hearing for us. Let's turn now to the space where tech meets education. You kind of want politicians to maybe brush up on their market knowledge. With schools shut and teaching forced to shift online, one firm has seen a surge in popularity, not in Washington, but around the world in homeschools. Kahoot, for those not in the digital education field or not parents, is a browser-based educational tool that offers learning, games, and multiple choice quizzes. In the last year alone, more than 1.3 billion users have joined. As a result, Kahoot's stock has soared more than 300% in a year and now has a valuation of $6.7 billion. The firm is planning on a dual listing in the U.S. and Oslo in March. And joining us now to talk more about that is Eilert Hanoa, Kahoot's CEO. Eilert, thanks very much for your time. It's not just kids, right? I mean, Kahoot also helps to teach adult people working for corporations.
Yeah, first, thank you very much for being able to be on your show. Yes, Kahoot is all about learning and making learning awesome. And that's, of course, not limited to age or situation. It's both in classroom, at home, for self-study, at work. Some of the most boring sessions we all have experienced probably have happened at work. And also, of course, in any kind of setting where it's all about making learning awesome and sharing knowledge and create this enthusiasm with the audience when you're presenting out.
So what is your USP? I mean, what makes Kahoot different than other online learning software suites, other online learning websites, other online learning platforms?
Yes, I think what is the strength of Kahoot is that it's super simple to use, both for those who are creating a presentation and for the audience to engage. It's also a platform in the sense that the content on the Kahoot platform is made by our users. Over 100 million Kahoots, which is sets of questions, are created by our users on our platform. Over half of them are available for free for everyone. In addition to that, we have great partnerships with publishers like Disney, National Geographic, Marvel, iCivics, PBS, Kaplan, Cambridge University Press, and other great local and international publishers that are providing their content on our platform for free for everyone. So I think it's all about this customer and user-generated content, similar to what you find on YouTube for videos, obviously, that you really create this extra enthusiasm around the platform, and that it's free forever for teachers to use.
So, and thousands, if not hundreds of thousands of teachers are using it. Millions of kids, obviously at home right now because of lockdowns, are using it as well. How do you expect usage to develop once lockdowns are lifted? Are you going to see what kind of drop are you going to see in users?
Yeah, first of all, we have already 1 million teachers logging in every week on our platform from around the world, from over 200 countries. So that's an amazing user group that we have to cater to. We did see the growth over 200% year on year in trading, although small revenue numbers, already prior to the pandemic. So we expect the blended learning situation, which we probably will see going forward, a combination of being present and virtual or video conferencing for any kind of teaching, whether it's at school, home, or work, will also continue. But the DNA of Kahoot and the true enthusiasm around Kahoot came from being everyone present in one big auditorium. So we definitely believe that regardless of how the pandemic will pan out, we will be there with great new features that cater to both the blended, the video, or back to normal, if you will, scenarios in the future.
What are you hoping to do with funds from an IPO? How can you expand?
So we already have positive cash flow from operation for the last 5 quarters. We have a cash balance of $250 million and no debt. So we have a fairly good starting point prior to this IPO already. We continue to invest heavily both in the product, the innovation of how to make learning awesome also in the future. But we also look at non-organic growth opportunities such as joint ventures and also, of course, acquisitions down the road. So we are very enthusiastic and excited about the opportunity to be on the main list on Oslo Stock Exchange.
All right, Eilert, thanks so much for your time. Really appreciate it. Fascinating story, and one that I think connects to a lot of people right now who are working from home and have kids learning from home as well. But as you said, it's also used by corporate clients. Eilert Geertsen Henoa there, the CEO of Kahoot. Now coming up, Swiss Re adds $900 million to reserves for pandemic claims. We'll speak to the CFO, John Dacey, about the latest company earnings. This is Bloomberg. Welcome back to Bloomberg Markets. This is the European Open. We are 45 minutes into the session right now, and we're looking at some gains in Europe. Not huge gains. The CAC 40 up 0.3%. The FTSE down a little bit, but that has a lot to do with the strength right now of the pound, which is ever nearer to $1.40. So definitely something that we're going to continue to watch is the cable rate at 139 and change. Now, just south of me, well, maybe 8 hours south of me. Swiss Re set aside $3.9 billion last year against future claims related to COVID-19. That includes an extra $900 million in the fourth quarter. The world's second largest reinsurer warned about the pandemic's continued impact on businesses and the economy. Joining us now is John Dacey. He is the CFO of Swiss Re. So, John, pleasure to get some time from you on what I know is a very busy day. Why don't we start with your outlook for pandemic-related claims and reserves for 2021?
Sure. So after the $3.9 billion that we've put up in 2020, we've been able to be fairly concrete about what we would expect in the property casualty businesses for 2021. And that's a total loss of less than $500 million during the course of the year. This would cover losses from events that are canceled, from business interruption claims that are covered under certain policies on property, and credit and surety and other casualty losses that might be impacted. Where we have a little more challenging time to estimate what the losses could be in 2021 is with respect to our life and health re business. And there what we said is that's going to depend on the number of people that succumb to the illness during the course of this year. We've seen some encouraging numbers in the drops of caseloads in most Western economies. We expect that to continue. With the onset of vaccination programs in place, we also hope that you're going to see a steep decline in deaths. But we can't predict that, and so we'll have to measure this on a month-by-month basis with the reality that we find in various countries.
So what kind of premium increases are you seeing? And do you think that they're going to be enough to compensate for the losses that you saw in 2020 for the losses that you're seeing at the beginning of this year?
Yeah, so in our reinsurance business for property casualty risks, we actually have a large renewal on January 1. There we saw price increases on a nominal basis go up by 6.5%. We were actually quite restrictive in making sure that we know what we're covering, and we're encouraging our primary companies to do the same with clarity on what risks are in and what risks are out. And we've been able to exclude in almost all the cases any cover of infectious diseases driven business interruption. It's unfortunate for society. We understand that that's challenging, but the reality is that this is a risk that's very, very difficult for the insurance industry to be able to cover. So we've cleaned out the book and the exposures there. We've reduced the amount of exposure we have for event cancellations, and I think going forward, we're in much better shape. We've lowered our guidance, or actually improved the guidance for the combined ratio targets, both for P&C Re and for our large commercial business corporate solutions.
Do you have any exposure to, in any way, vaccine rollouts or problems that could arise from them?
Typically not. We've not been a big reinsurer or insurer of the pharmaceutical industry for a number of years, and in many cases, these industries or this specific rollout related to COVID-19 are being sponsored by governments in ways that actually reduces the industry risk materially. What I would say is, we're strongly encouraging a organized and dedicated rollout of the vaccine across the countries, affecting first the essential workers and secondly those at highest risks. In a country like Israel, where we see this a little further along than almost any other jurisdiction, we've seen the massive change in the infection rates for people that are at risk, and we're starting to see some indications that the mortality related to this is also dropping. So we would expect in places like the UK and the US, which are also doing a better job, relatively speaking, of rolling out the vaccines, for the caseload to start dropping significantly.
John, what about, the other issue, not just the pandemic, but that we're looking at right now is climate change. With this deep freeze in Texas, it looks like one of the main problems is nobody thought in San Antonio that you needed to insulate your pipes, right? It just doesn't get that cold. It's like insuring against earthquakes in Chicago. There's just not really a reason to, but maybe now there is. How does climate change affect your business?
So there's a series of what we call secondary perils that involve windstorms, tornadoes, hail, floods, and wildfires, which have all seen an increased frequency in recent years. That's separate from the primary perils like hurricanes and earthquake, which unfortunately has also been problematic for the industry in recent years. But having said that, I think the world is just going to have to help get itself more resilient to major fluctuations related by climate, typically with heat and dryness, but not always, as Texas is showing us. And so I think part of our job is to work with our own models to help people understand what risks are really out there, price those risks, and behave accordingly to try to mitigate them as much as possible.
John, thanks so much for joining us. John Dacey, Swiss Re CFO, talking us through some of the changes that I guess we're going to have to face together as a society. And of course, his company is helping along that battle as well. Coming up, NatWest resumes its dividend as the lender exits its Irish business after more than 150 years. We'll hear more about this week's European bank earnings with our MLive editor, Heather Burke. This is Bloomberg.
What we always say on M&A is that if it's something that can add appropriate volume to us, because we do have capacity to grow in quite a number of our areas, or it can add real capability that we don't have, it's something that we'd look at.
We feel very good about our growth opportunities on the investment banking side, but also especially on the private banking side.
We've invested in our investment bank for the last 5 years, and I think last year has started to pay real dividends and allowed us to be profitable every quarter.
There you hear from European bank executives sharing their views on earnings this week. We've had really a wide range of bank earnings. So some, like Barclays, have done really well. Some, maybe, for example, French banks have done more poorly. Here to round up European banks with us is Heather Burke, and editor for the MLive blog. Heather, what do you think? Is there one single solitary thread across European banks, or has the divergence just been too strong?
Good morning. The big theme that I've seen in banks the past few weeks is you've definitely had some beats, but any whiff of uncertainty is spooking investors. Barclays is a great example of this yesterday. The bank had a really strong end of the year. Its investment bank beat. It's delivering a share buyback and a return to dividend. But the bank said the outlook for 2021 remained uncertain. The pandemic's hurting its UK business, and that sent the shares down over 4%. And today you've got NatWest saying, they're resuming dividends too and setting new targets, but they also said that the COVID outlook continued to make the outlook uncertain. The shares are not as stark as Barclays yesterday, but that's a theme that we're seeing, and that and we're seeing that wider in earnings. Any kind of hint of uncertainty, is kind of deflating the reflation trade.
All right, Heather, great to have your take on this, and I'll recommend viewers who have Bloomberg terminals in front of them go to MLIV Go to get more from Heather Burke and the MLive team. That's it for the European Market Open. Surveillance Early Edition is up next as the pound continues to move closer and closer to 140. It's at 139.95. Watch cable. This is Bloomberg.
apologize, and I'm not going to say that Robinhood did everything perfect.
Mr. Cheneb, isn't it possible that the issue is not clearing houses, but the fact that you simply didn't manage your own book?
I'm not a cat. I am not an institutional investor, nor am I a hedge fund.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Welcome to Bloomberg Surveillance Early Edition on this Friday, the 19th of February. I'm Francine Lacqua in London, and here's what's coming up on today's program. U.S. lawmakers grilled the key players in the GameStop frenzy. In a 5-hour hearing, the Robinhood chief executive, Vlad Tenev, takes most of the heat. A vaccine surge is coming. Bloomberg analysis finds that America's rollout is about to get a big boost. But what about those left behind? 130 countries are yet to vaccinate even a single person. We'll discuss the outlook for emerging markets with Mark Mobius shortly. Well, good morning, everyone. We do have a bit of data out of the Eurozone, but we also had some data in the UK. It went to that there was an ugly reading, but despite that, pound actually climbing above $1.40 for the first time since April 2018. Again, this has more to do with the vaccination story, the fact that I think today they also announced that people above 40 will be vaccinated in the next 2 to 3 months. So the UK clearly powering ahead when it comes to vaccination. So Europe, PMI is just breaking across the Bloomberg terminal. I think a touch below estimates, but not by that much. Let's get straight to our Danny Berger, who has the very latest. Danny, what are you seeing?
Yeah, Francine, a real divergence here, as we've been seeing for the entirety of the pandemic, between services and manufacturing. Now, looking at the overall level for Euro area PMIs, it did stabilize around the January number of 48. So this one coming in at 48.1, as you say, slightly better than expected. Now, when it comes to services, the disappointment here. 45.9 was the expectation, came in at 44.7. And then a beat for manufacturing for the Euro area as well at 57. Estimate was at 54. And you can see this reflected in the German PMIs here, which we got earlier in the day, and the French PMIs as well. It's a weak service sector and a strong manufacturing sector. Now, I should say it is a little bit surprising that the manufacturing sector is doing as well as it is, given the disruption to supply of semiconductors, especially to automakers. So we have seen higher risks to manufacturing, but for now, holding up strong, acting sort of as a counterweight to the weaker services sector, Francine.
What's the U.S. like, Danny? Are we seeing any signs of these price pressure? I mean, are we seeing signs of price pressures that we're seeing in the U.S. in the Euro area?
Well, we do get U.S. PMIs today, but when it comes to price pressures, it really is all about the U.S. That's where the game is at this moment. And yes, we did see some indications that investors are looking for price pressures in the Euro area. Last week, we had German 10-year yields, for example, turn positive for the first time in a few months. But still, when you look at, for example, the spread between break-evens in the U.S. and Germany, so an inflation gauge, Germany is at a record low. So any signs of pickup, even though we do see manufacturing, for example, do better today, it doesn't really seem like it's sticking around. It doesn't seem to be any sort of lasting price pressures when you make sense, considering the slower rollout of vaccines in Europe and still shutdowns in many parts of the region.
Yeah, talking about shutdowns, but the other kind, the energy kind, of course, this has been the big market story of the week. Danny, the Texas oil patch slowly restarting. How have the markets reacted?
So we are seeing oil fall for a second consecutive day. And as you say, this is as Texas starts to come back online. The Biden administration also possibly discussing meeting with Iran as well. So that, of course, brings the picture of exports from the Persian Gulf nation in as well. So you can see things like heating oil futures also moving lower as well. So some of that pressure being taken off. But let's be clear, the energy crisis is still here. It's going to take a while to get everything back on. But Goldman Sachs does say that they think that this will be a fleeting price issue, that demand loss is being offset right now. And so we will see just a small and transitory impact to the markets, Francine.
Danny, thanks so much. Our Danny Berger there with a roundup of the week's top market themes. Now, coming up next, the U.S. and the UK make great strides on their vaccine drives. But what about those countries yet to begin their rollout? We'll be speaking to emerging market specialist, emerging market guru, Mark Mobius. He's up next, and this is Bloomberg.
is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
I am not an institutional investor, nor am I a hedge fund.
We had no role in Robinhood's decision to limit trading in GameStop.
I want to make clear at the outset that Melvin Capital played absolutely no role in those trading platform decisions.
It's important to understand that Wall Street Bets is one of many finance and investing related communities on Reddit.
America's retail investors play an important role in our capital markets.
Investors who opened accounts for the first time in 2020 were younger, had lower incomes, and were more racially diverse.
I like the stock. I'm as bullish as I've ever been on a potential turnaround for GameStop, and I remain invested in the company. Thank you. Cheers, everyone.
Some of the opening statements there from the key players in last month's meme stock frenzy testifying before Congress. Now stay with Surveillance, the early edition, because at 5:30 we will talk more about the GameStop hearing. Now let's get straight to the Bloomberg First Word News. Here's Laura Wright. Hi, Laura.
Hi, Francine. The Biden administration says it's willing to meet with Iran to discuss a diplomatic way forward. It's an effort to return to the nuclear deal that President Trump quit back in 2018 and a step toward easing tensions that have risen steadily over the past 4 years. A State Department source tells Bloomberg the moves are not a concession to Iran, but a concession to common sense. The US is likely to hold off sanctioning any German entities over Nord Stream 2. Sources tell Bloomberg the Biden administration is looking to halt the project, but doesn't want to antagonize a close European ally. A key report to Congress is expected to list only a small number of sanctions linked to Russia. NASA is celebrating the landing of Perseverance on Mars, the largest and most sophisticated rover to get to the red planet. It's the trickiest landing NASA has ever attempted, in a crater strewn with boulders, sand dunes and cliffs. The rover also carries a drone helicopter known as Ingenuity, which will be the first craft to attempt to fly on another planet. Global news, 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Thank you so much, Laura. Now, the U.S. is set to supercharge its vaccine rollout. Analysis by Bloomberg shows vaccine supply in America is set to double in the coming weeks, allowing a broad expansion of doses administered across the country. By June, our data team expects them to hit 4.5 million shots a day. While the U.S. and the U.K. could achieve herd immunity by the end of the year, the outlook, of course, is completely different in emerging markets. Well, according to UNICEF, 130 countries have still not administered a single dose of coronavirus vaccine. That's 2.5 billion people, largely concentrated in poor parts of the world. Now, add to that the new variants in South Africa and Brazil, which have thrown doubt on the efficacy of available vaccines. So, will emerging markets actually get left behind in the recovery? Well, joining us to discuss all of this is Mark Mobius, Mobius Capital Partners founder. Mark, thank you so much for joining us. As always, there's a lot of questions about inflation. We want to get into some of your outlier calls. But overall, how worried are you about the emerging market countries that don't have already access now to vaccines?
I'm not worried at all for a number of reasons. First of all, one of the amazing developments is the fact that in India, for example, despite the fact that most people are not vaccinated, the number of cases is going down. So I think it may be because it's a relatively young population, and also maybe they have developed resistance. And I think you're seeing that in parts of Africa as well. So it's a very interesting development. In other words, there's no need for everyone to be vaccinated, and in fact, no need for the majority of people to be vaccinated in many of these countries.
I mean, that's definitely an outlier call to some of, the other analysts that we were speaking to. Mark, does it mean that do you still like the frontier markets, given what you've just said? Where do you see the best value for investors to go into right now?
Well, right now, if you look at our portfolio, you see India is at the top of the list, followed by Taiwan, Korea. We have some investments in China. And then we're in Turkey, we're in South Africa, we're in Brazil. Those are the key countries that we're in now. And I believe going forward, a lot of these frontier markets are going to be very interesting. Of course, the problem in these markets is liquidity. But otherwise, we do have one investment in Kenya, Safaricom, and we expect to do more in frontier markets.
Mark, I also wanted to point to a Goldman Sachs note, and our John Normand, who's a regular guest, as you are, on surveillance, basically says if a particular allocation across a risky market spectrum should be low confidence this year, it is EM overweight. Do you worry about dollar dynamics and what happens to yield curves and the impact that has on emerging markets?
Well, it's interesting to see how emerging markets performed. Since March of last year, we're up 80+% for the index. And of course, many portfolios are even better than that. And I think going forward, yes, there's going to be concern about the normal issues of currency and so forth. But many of these emerging market currencies, surprisingly, even countries like the Rand in South Africa have appreciated against the US dollar. So I think we've got to look at, of course, interest rates. If interest rates go up dramatically, then markets generally will be in bad shape. But if you look at the general inflation numbers, we're not too worried about that. And in fact, in my new book, The Inflation Myth, I basically say the inflation numbers are really very erroneous and should not be relied upon. So we're in a situation where we're in the year of the bull, let's put it that way, the year of the ox for the Chinese, which is a bullish environment. So I think we're in pretty good shape for further bullish news going forward.
So, Mark, are you saying that actually we're reading inflation wrong, that we don't have the right tools to measure it, or you just don't think that it will be here and it will be sticky inflation that will force central banks to act?
Correct. What the central banks are relying on are erroneous CPI and other inflation measures. As I pointed out in the book, lots of errors. And it's crazy for them to be relying on these numbers and even considering movement when there's a 0.5% change. That doesn't make sense. The other thing I point out is that, of course, prices are rising, and that's because of currency devaluation. And it's really interesting to see how a young generation of people are relying more and more on Bitcoin and some of these other currencies, the currencies that are fixed in terms of the amount that can be generated. So if that's the case, then the whole movement is towards a more stable kind of currency where the printing press is not running overtime. So it's going to be a very interesting development. We're in very exciting times when it comes to currencies.
Mark, you're a bull when it comes, I guess, to stock and some of the currencies. What's in a bubble? Is there a bubble part of the market that could burst this year?
Of course, there are a number of bubbles in the market because with the kind of liquidity we have and the fact that you have a lot of retail investors that have come in through Robinhood and other platforms who, are locked down in COVID and don't have much time to do anything else except look at their screens. So I think that's part of the issue, and that inflates a number of companies. But I keep on telling people, look, you can keep your head in the clouds, but keep your feet on the ground. And if you are looking at companies, get good, solid companies with good balance sheets, and you should be doing fine.
But Mark, what are you suggesting? That retail investors don't understand the pitfalls by, in trading, like for retail traders in Robinhood, or what was your main takeaway from the hearings yesterday?
Well, I think the main thing is that yes, there are a number of people that are not informed and are moving on the basis of sentiment. And it's paid off for many of these people. They really have not looked at the numbers of these companies. And many of them will regret having done so. But you must remember there are others there. Quite a number of young people are very intelligent, very knowledgeable, and they will be doing the right thing. They'll be looking at the company's balance sheets, profit and loss statements. So my takeaway from the hearings, I didn't hear all of the details of the hearings, but my takeaway is hopefully at the end of the day, they don't crack down on the retail market, and that platforms like Robinhood can continue to operate because it gives people an opportunity to participate in the market. And the only way you're going to get people to learn is by having the experience of failed in some cases in their investments and gained in others.
All right, Mark, thank you so much. We'll have plenty more on, of course, GameStop and the hearing yesterday. And we also have a viewer question, Mark Mobius of Mobius Capital, well, for him, so he stays with us. And that's actually on inflation and some of the Fed dynamics. Now, later on in the program, we'll also speak to Sam Fazeli, Bloomberg Intelligence, about the vaccine rollout. He's got a new opinion piece out today, and that's shortly after 9:30 London time. Now, coming up, less dumb than cash. Elon Musk defends Tesla's bet on Bitcoin, but distances the car company's move from his personal view. So we'll discuss Bitcoin with Mark Mobius as well. This is Bloomberg.
I'm surprised that Elon's so gung-ho on Dogecoin, but I think, look, this is the free, decentralized free world, right? Anybody can like anything. He can like Dogecoin for any reason he likes. And I strongly believe that he's not really associated with Dogecoin in any way. The fact, though, is that Tesla, I think, bought Bitcoin, not Dogecoin. Mm-hmm. So I think Elon probably likes it a lot personally.
The chief executive there of the world's largest cryptocurrency exchange by volume, speaking exclusively to Bloomberg about Elon Musk's interest in digital currencies. True to form, Elon Musk also responded to our interview with a tweet. He wrote, "Tesla's action is not directly reflective of my opinion. Having some Bitcoin, which is simply a less dumb form of liquidity than cash, is adventurous enough for an S&P 500 company. When fiat currency," he went on to say, "has negative real interest, only a fool would look elsewhere." Well, Mark Mobius of Mobius Capital Partners is still with us. Mark, I mean, your thoughts on Bitcoin? I know you weren't a fan. Now it seems to be adopted more by Main Street or certain components of Wall Street. Has it changed your view?
No, it hasn't, in the sense that personally I like to invest in gold and that kind of currency. But I can understand where people are coming from in terms of looking at Bitcoin and some of these other currencies, cryptocurrencies. And the mere fact that there's a limit to the amount that can be produced gives Bitcoin a aura of credibility, which is very, very important. So it's really interesting. You talk to a generation of new comers to the markets, you find that they have a belief in these cryptocurrencies. And look, currencies, wherever you are, it's a matter of belief. I mean, we believe in the US dollar or in the euro because we can spend it, we can buy things with it, and we believe that will be worth something at least for the foreseeable future. But at the end of the day, you have to look at the number of people who believe in it and who think it's credible. The bottom line will be how to convert these currencies into dollars or euros, and whether governments will begin to accept it for payment of taxes.
Mark, do you think you'll be buying Bitcoins? Yeah, do you think you'll be buying Bitcoins in the next year? Are you going to be a convert?
Probably will not be. I'd prefer to buy stocks and to be buying gold rather than Bitcoin.
All right, Mark, we have a viewer question, so thank you so much to that viewer. Please send us all of your questions or comments on IB plus TV Go. But our viewer, Mark, asks you, so regarding reading inflation wrong, so he agrees with you on your analysis, but he also says the Fed may be at least part of the cause. Can Mark comment on Fed buying more of a market which is in decline?
That's a very important question. And if you look at the example of Japan, you'll see that the central bank there, in their frustration and not being able to get so-called inflation up, they started actually buying stocks in the Japanese stock market. They bought the ETFs. So I wouldn't put past if the situation in America gets to the point where economic growth is not moving at all, you could see the Fed actually buying into the market. Who knows? So I think this is something we have to be very aware of, that possibility.
Mark, does that mean that we could actually see a move by the Fed to buy stocks like we've seen in Japan, or where does this end?
Exactly. I mean, if they think it's necessary in order to get inflation up, they may just start doing that. And of course, you could see in Japan, they were pushing on a string. It didn't work. But it's going to be interesting to see how the Fed reacts going forward. Of course, assuming that you have a lack of growth in the country.
Mark, if we go back to what you're expecting for inflation, and we touched on bubbles, what do you think is the biggest mistake that people can buy right now?
I think the biggest mistake that people can make now is to not get involved with stocks, with good, solid stocks that are earning money, that have strong balance sheets. Because at the end of the day, the dollar is going to devalue, as do all other currencies in the world, as I point out in my book. No currency holds its value. So what we're calling inflation is actually currency devaluation. So in order to protect yourself against that, you've got to be exposed to companies that are adjusting their prices to the devaluation of the currency. So it's very important for people to be involved in stocks. But I must warn them that it must be solid earnings companies that are going to be going forward in the next generation and growing in line with the economy.
Great, thanks so much. Mark Mobius there, Mobius Capital Partners founder, speaking to us on Bloomberg Surveillance. Now, coming up, Bloomberg Opinion. Sam Fazeli says, give Britain some credit in its fight against COVID-19. Up next, we speak to our Director of Research at Bloomberg Intelligence. He's a bit of an expert, especially when it comes to virologies, vaccines, and of course, trials of data. Sam Fazeli is coming up shortly. This is Bloomberg.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a taxi.
Welcome to Bloomberg Surveillance, early edition on Friday, the 19th of February. I'm Francine Lacqua here in London, and here's what's coming up on the program. U.S. lawmakers grilled the key players in the GameStop frenzy. In a 5-hour hearing, Robinhood chief executive Vlad Tenev takes most of the heat. A vaccine surge is coming. Bloomberg analysis finds that America's rollout is about to get a big boost. And is there life on Mars? Well, NASA successfully lands a rover on the red planet. Engineers say the robot is in good shape. So we have quite a lot of data today. We did have some disappointing data out of the UK, certainly in terms of retail sales. That is pretty much expected because of the lockdown and this third lockdown that we're living through in the UK. Moments ago, we're also getting PMI figures. We were talking to our Danny Berger, again, the difference between manufacturing and services. Now, manufacturing, a bit better than expected for the month of February. Services PMI, much better than expected because they're rising to 49.7 instead of the 42 forecast. Remember, anything that's below 50, though, still indicates a contraction. You can see pound touching 140. That's a key psychological level. It touched that about 32 minutes and currently holding on to that at 140.06. Now, House Democrats sparred with heads of Robinhood and Citadel yesterday during a Financial Services Committee hearing over the GameStop frenzy. Lawmakers pressed the firms on whether they're profiting at the expense of retail investors and complaining that they got few satisfying answers. Well, joining us for more on this is Bloomberg's Danny Berger. Danny, I mean, it was pretty entertaining. A lot of people were commenting, get the popcorn out. What were the big sticking points for lawmakers during the hearing?
Yeah, we got a huge range, Francine. I think that is part of why it was so entertaining. You got some people asking questions that, frankly, were a little bit confusing. For example, one lawmaker asked Vlad Tenev why Robinhood was called Robinhood. You had some lawmakers who were able to sort of venture into the more wonky territory. But overall, the sense that we got was that this was a serious event and they felt the need to do something about it. Now, whether that something was directly related to the volatility around GameStop or not, now that's a different question. We didn't really get exactly at those few days. Instead, it was very big picture. For example, has trading become gamified because of firms like Robinhood? Is payment for order flow, is that bad? Are retail investors at a disadvantage to hedge funds? Which, Francine, of course they are. At the end of the day, hedge funds have the time, they have the resources, they have the money compared to a retail investor. Short selling was also under the microscope as well, calls for more transparency. But it really is one of those things, if there was more transparency on shorts, how much of a difference would that have made? I can't imagine it would have prevented the GameStop saga from happening. If anything, it could have fueled it even more.
Yeah, I have to say, Vlad Tenev of Robinhood really, got most of the anger. On the one side, a lot of congressmen were angry that he didn't do more to try and polite the mom and pops investors that were on that side, and that then he shut them out. Is he going to do any changes at Robinhood?
Definitely painted as the victim in some regards. I think kind of the big thing coming out of it in terms of changes was this apology he issued. He said he was sorry, that Robinhood needs to do better. They're focused on changing and really being better as well. But when asked what was he apologizing for, he said, I admit to always improving. So not a flat out apology or saying exactly what it was for. But when he says, we're committed to making sure that we improve from this, one of the really tense moments came from when one lawmaker, representative from Illinois, said, let's see what happens when you call Robinhood. And when you call, you just get a pre-recorded message directing users to Robinhood's website. So the customer service angle, that was really hammered down as an issue that Robinhood needs to fix.
Roaring Kitty, the other star of the show, is not a cat. I'm not a cat. I've always wanted to say that since that meme came out. What sort of questioning did he get?
Well, no questioning as to whether he was a cat or not. I think that was probably apparent. He didn't get a lot of questioning. We had his opening statement that he had prepared that I thought was almost touching. He talked about how the millions he's made has been really great for his family. At one point, they asked him, do you like GameStop? Would you still buy it now? He said, yes, I'm a buyer. Earlier when these pictures, he said earlier when I'm buying it, he did not look like this, Francine. I can tell you that during the hearing. He did have that chair behind him, no cigar. He also did not wear his signature bandana. It was hanging on the wall behind him, but I think there was a lot of disappointment he didn't don it for the hearing.
I know, but it was just there, perfectly placed, Danny. It was
right next
an
to
interior
a cat poster.
designer. Yeah, I love that. So it was actually quite funny. Danny Berger, thank you so much for the hearings, the update of the hearings that really had us glued to our television screens yesterday. Now let's get straight to the Bloomberg First Word News. Here's Laura Wright. Hi, Laura.
Hi, Francine. Iran says the U.S. will have to lift sanctions before it will agree to talks. It comes as the Biden administration is trying to ease tensions with the Islamic Republic, looking for a diplomatic way forward. The White House wants to return to the nuclear deal that President Trump quit back in 2018. A State Department source tells Bloomberg the moves are not a concession to Iran, but a concession to common sense. The European Central Bank is strongly considering disclosing climate risks in its bond buying programs. Sources tell Bloomberg it will now focus on collecting the data to achieve that. ECB policymakers discussed the issue on Wednesday as part of the central bank's strategic review. No official comment yet. Senator Ted Cruz is back in Texas after facing harsh criticism for flying to Cancun, Mexico, while his state faced widespread power outages and an energy crisis. In an exchange with reporters, Cruz said the trip was obviously a mistake, adding the reason was because his children were cold and he was just trying to be a dad. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg, Francine.
Laura, thank you so much. Now, today there's a great opinion piece, this time from the Director of Research at Bloomberg Intelligence, Sam Fazeli. In this piece, and I urge everyone to go and read it either on your terminal if you're a subscriber or onto our website, Sam Fazeli argues that the UK should be getting more credit for leading the fight against COVID-19. Now, he says that despite the political stumbles throughout the pandemic, there is a lot to be admired. If you're a terminal user, of course, you can go onto Open for opinion, but OPIN go. Well, Sam Fazeli, always smart on the vaccine, the rollouts, and when we can get back to our normal life, joins us this morning. Sam, I feel like actually the fact that Britain got the vaccine rollout right is at least priced in the markets. Why do you think they're not getting enough credit?
Yeah, I think, Francine, and thank you for all the very kind words you've said. It's less about whether they're getting credit for it or not, but it's, you know, the British themselves especially are pretty good at being constantly critical of everything that the country has, like the National Health Service, etc. So, but when you look at the totality of what's been going on in the UK, the recovery trial, the experimental vaccine rollout, I'll have to say that because I'm still not 100% sure, and I don't think anybody will be until we see the efficacy and the data in the general population of this one dose and then the next 12 weeks later strategy. And then when you look at the genomics efforts, a lot of things that the UK has been doing have been exemplary.
When you look at, you know, I was quite taken by some of the vaccine rollout, and we're studying this. Now, we expect a double of doses, I think, in the US in the next couple of months. But then Anthony Fauci saying, despite that, he doesn't expect anyone returning to normal before Christmas. So how do you see this panning out? You know, a lot of people want to just figure out what the next 10 to 12 months will bring.
Yeah. Let's put aside all the discussion about the variants and whether we need another booster shot for the variants or not. But based on what we have already and the speed with which vaccinations are happening, we have to consider the fact that if you really want to reduce the number of hospitalizations, you should be able to see that relatively early on, hopefully in the second quarter in the United States, as the at-risk population is mostly vaccinated by then. But of course, what we don't want to do is to let the virus start spreading rapidly again as people who are not vaccinated are still exposed. And even those who are vaccinated, you know, this vaccine's about 90% effective. You still have that 10% who could catch the infection. And that, of course, then leads to the risk of continuing mutations in the virus. So I think we're going to stick with the third quarter, which BI has been of the view that third quarter is the quarter that we should start seeing some semblance of normality returning.
Sam, when you look at the rollout in some of the developing countries, so we have this alliance with France and also the UK today announcing that they will give some of the surplus to developing countries that need some of the vaccines. But 130 countries, you know, as far as we understand, haven't administered a single shot. Like, you know, what does this vaccination nationalism lead to?
Yeah, so nationalism or not, I mean, what we really want to see is a significant effort, a much more magnified effort in trying to get vaccines into those countries too. You know, vaccinations just in the UK and France and the United States are not going to be enough to get rid of this or to control this pandemic. Remember, these variants can occur anywhere where there are infections running at high rates. So it's absolutely crucial that we get this right. And I'm a little bit worried that all this negativity, a lot of which I believe is actually misplaced against the AstraZeneca vaccine, which has the highest number of doses potentially available in 2021, is going to backfire. And I think countries and politicians have to be a bit more careful with how they comment and refer to the vaccine and issues to do with it, which a lot of times, in my view, are misplaced.
Sam, what do you make of the variants? How many new variants could we have, and how dangerous is it that we're vaccinating when the virus is still so prominent around the world?
Yeah, so Google has a way of calculating really big numbers, and one of those is to try and calculate this one with regards to the number of potential variants, is that you have 4 nucleotides in this virus, and there's 30,000 nucleotides. That's 4 to the power of 30,000. Even Google can't calculate that. Will we get that many variants? No, but we will continue to see variants occurring. Currently, the worst one seems to be the B1351 variant that was first observed in South Africa. That's the one that we have to focus on today, but we will continue to see more.
Sam, thank you so much. Sam Fazali there, of course, who covers vaccinations, viruses, and pharmaceuticals for us for Bloomberg Intelligence. And if you want to read his opinion piece, just type OPIN on your Bloomberg terminal. Now, coming up, we speak to Silvia Merler, Algebra's Policy and Research Forum, head of research on Draghi's recovery plan and why it's so important for the government to get it right now. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, the early edition, and I'm Francine Lacqua here in London. Now, the Italian Prime Minister, Mario Draghi, wins support for his government's economic priorities in Parliament. He will focus on EU integration and speeding up Italy's vaccination campaign. Now, Draghi will also take part in his first G7 virtual meeting today. Joining us to discuss all of the rebuilding of Italy by Mario Draghi is Silvia Merler, Algebra's Policy and Research Forum, head of research. Silvia, as always, thank you so much for joining us. When you look at actually what Mario Draghi has to do, it's no small feat, but will he also, apart from rebuilding Italy, can he be the voice of Europe? Can he rebuild Europe because of his past job as ECB president?
Absolutely. I mean, that is probably the key question for this government going forward. And I think where we can see the benefit of having someone like Mario Draghi as the Prime Minister of Italy is not only in obviously improving the economic and social outlook for the country and ensuring that the money from Next Generation is spent well, but also in driving very important discussions that are coming up in Europe, particularly on the reform of the fiscal rule setting for Europe and for the Eurozone more in general, and on probably pushing forward further integration, especially in terms of bringing this first step towards fiscal integration at the European level, transitioning it into something that is more similar to a permanent federal spending capacity. I think if there is someone that can do that, definitely Mario Draghi is the person.
But Silvia, what's his main challenge? Is it trying to make sure that the political parties don't start rowing again in Italy? So is it a domestic problem, or is it really the vaccination rollout and things are outside his control because it's the EU that's in charge?
It's really, I'm sorry, that's my cat in the background. For the pleasure of working from home, but I think it's really a mix of things. So definitely the most immediate emergency is the vaccination plan. Partly that has been outside of the control of the government because of the supply constraints that we all know about for European countries, but definitely speeding up the rollout is essential for speeding up the recovery as well. When it comes to the government, this is a very different situation from the previous technocratic government that we remember, so Monti government in 2011. This government does not need to cut spending. This government needs to spend actually a lot of money, which is, however, something that Italy is not really good at doing, because if you look at the performance in spending structural funds from Europe or even at domestic public investment, there's a lot of reasons for not being very optimistic about this. So this is definitely going to be a priority. But then, at least in my view, the biggest task will be to make sure that also those enabling reforms that ensure a high multiplier for this investment spending will be done. And this is where previous governments, regardless whether they were fully technocratic or fully political, they have come short of expectations repeatedly.
But Silvia, this is job losses, right? This could be like, millions of job lost with restructuring and also cutting bureaucracy. When do we know whether Mario Draghi can achieve it and whether he'll do it and survive it?
Well, I think the first step will be to see what the revision of the National Recovery and Resilience Plan will be. So there is a document that was prepared by the previous government with a number of key spending priorities and allocations, but that document was not really very explicit about the reform element of the package, and also not very explicit about the governance of the spending. So those two issues were very much left unaddressed in the previous government's plan. So I think this is where we will see where the new government plans to make a difference. When it comes to the composition of the government, I think this is a very smart government compared to, for example, Monti's government in 2011, because the key ministries, the ministries that will be key for the success of the spending plan, have been given to outsiders, so to technocrats that really have a very good track record in the private sector for the specific areas that they're going to be dealing with, but they are, so to speak, ring-fenced, to use a financial term, by a lot of political ministries in other positions that may be less relevant, but will ensure that the parties have enough skin in the game to provide for the political backing that this government necessarily needs to have to implement those reforms that I was mentioning previously.
Silvia, do you really see a more integrated Europe, or do we need to see much more convergence, first of all, amongst the countries?
Well, there actually has been a lot of convergence. So if you look at the period following 2010, so between 2010 and the outbreak of the COVID crisis, there has been a remarkable amount of macroeconomic convergence across countries, which has been unilateral in a way, because it's the so-called peripheral or southern country, Italy excluded here. I'm talking about the countries that went through macroeconomic adjustment programs. They really converged massively towards the economic growth model of northern or core countries, so Germany and the northern European countries. And this is somehow lost in the debate. And I think obviously when COVID hit, everybody started focusing on that. But the convergence has happened to a large degree. And this is probably why this is the time when discussing about fiscal integration is possible. Then there's obviously the big question of Italy, because Italy did not go through a comparable adjustment. And so in a way, today, the country remains an outlier. And this is why success of this plan in Italy and ownership of this plan in Italy is the one element that I think will determine where European integration will be moving in the next 5 years.
Sylvia, thank you so much, as always, for joining us. Sylvia Merler, their Algebris Policy and Research Forum, head of research. I was hoping really for a cat cameo, but Sylvia will have to send it on social media. Coming up, is there life on Mars? Well, David Bowie's question may finally be answered as NASA successfully lands a rover on the red planet. We'll discuss that next. I also get my pronunciation of David Bowie correctly, because I think I mispronounced it. This is Bloomberg.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Touchdown confirmed. Perseverance safely on the surface of Mars, ready to begin seeking the sands of past life.
Images there of the team at NASA celebrating the successful landing of a new rover on the surface of Mars. I have to say it was pretty exciting for those of us watching at home as well. The engineers at the U.S. Space Agency saying that the robot is in great shape. Well, joining us now is Alex Webb from Bloomberg Opinion. Alex, I know you love space. You've been looking at this mission. I mean, it's really captivated the imagination of so many people. What's the exact aim of this mission?
Was there life on Mars, essentially, or was there life on Mars? I think perhaps more pertinently, they landed in this crater, which billions of years ago was in fact a lake. And as we know, where there's water, often there is also life. And so the intention is to establish whether that water had created life or at some stage in the past. The odds on there being life there now, probably not very big. And also inevitably, when we talk about life, we're thinking about sort of single-cell organisms rather than walking, talking Martians.
Thank you so much, Alex Webb there, of course, covering that, and we'll have plenty more from Alex Webb throughout the day. Now, we're just getting some breaking news out of Uber, which this has been a 5-year legal fight over the employment status of the drivers of Uber. This is from the UK. It's gone through all of the courts up to the very top one. And basically, Uber has lost the UK top ruling on the driver's employment status. Now, that means they have employment status, and with that, of course, there are rights that Uber will have to pay their statement. So these are these judgments. I mean, we used to see them in courtrooms. This is a virtual judgment. I believe that this is probably the main judge involved. But again, Uber Technologies lost the ruling from the UK's top court. That basically means that their business model will be different because they now have employees and not freelancers. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller joins me out of Berlin. Kaylee Lyons from New York as well. This is Bloomberg.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
Apologize, and I'm not going to say that Robinhood did everything perfect.
Mr. Tanev, isn't it possible that the issue is not clearing houses, but the fact that you simply didn't manage your own book?
I'm not a cat. I am not an institutional investor, nor am I a hedge fund.
This is Bloomberg Surveillance Early Edition with Francine Lacqua, Matt Miller, and Kaylee Lyons.
Live from London, Berlin, and New York, I'm Francine Lacqua with Matt Miller and Kaylee Lyons, and these are our top stories today. U.S. lawmakers grill the key players in the GameStop frenzy. In a 5-hour hearing, the Robinhood chief executive, Vlad Tenev, takes most of the heat. A vaccine surge is coming, while Bloomberg analysis finds that America's rollout is about to get a big boost. And power begins to return to Texas, but the energy crisis that sparked the outages continues. Well, good morning, everyone, and welcome to Bloomberg Surveillance, the early edition. Now, we actually begin with some breaking news. President Joe Biden is ditching Trump's America First approach. In remarks to the G7 and a speech at the Munich Security Conference, Biden will portray collective action as essential. We're just getting some headlines crossing the Bloomberg terminal on, of course, the wanting to discuss Iran, Russia, China, and Afghanistan. Interesting to have some of his thoughts on China, saying he doesn't want competition, or he wants competition, but not confrontation. Although, Matt, we have been hearing that this administration could be just as hard in substance, if not in tone, with China.
Well, and to be fair, the wheels are already turning in terms of independence militarily here. I mean, look, over the last 4 years, Europe was told time and time again, it's time to, put on your big boy pants and start defending yourself. You've got to not only contribute more to NATO, but you've got to start taking part in your own defense. And they have taken that to heart and will be doing that. So even if Joe Biden wants to, play more together, I think the Europeans have learned an important lesson here that they need to defend themselves to some extent. And so that's already starting to happen.
Yeah, it was interesting also yesterday to hear Joe Biden talk about the Iranian nuclear deal, saying he's ready to negotiate, but because it was part of the linchpin of his campaigning, I don't know whether Tehran will go to the table or not. Kaylee, I don't know whether this plays out at the markets, but certainly the markets are looking at yields, inflation, and GameStop.
Yeah, always looking at GameStop in recent weeks, Francine. It seems that we cannot escape it quite literally. But it is interesting, the Friday session getting a little bit more exciting as the future session grows older. We are now actually positive on both S&P 500 and NASDAQ futures to the tune of about 1/4 to 0.3%. You were just speaking about Iran, though, Francine. That may be a factor in what we're seeing with crude prices lower by about 2% when it comes to futures, below $60 a barrel on WTI, though that energy crisis, that easing energy crisis in Texas is also a factor. The issue now isn't so much on all the supply that came offline. That is starting to come back, but refineries are still down and could take weeks to come back online. So supply really or demand may be an issue more so than supply. Goldman Sachs saying that basically means any impact on the oil price is going to be small and really quite transitory. You are still seeing natural gas futures up about 0.4%, but that's after a sell-off of more than 4% yesterday. In addition to that energy crisis, another story we have been watching closely this week is what is happening in the bond market. That reflation trade pushing yields higher over the last 5 days. The 10-year Treasury yield up 9 basis points, 1.3% is where we sit. Of course, selling on the longer end, leading to a steeper curve. 153 basis points separates the 5 and 30-year yield. The most interesting story, though, break-evens coming down, those inflation expectations re-rating lower just a touch, sitting at 2.17%. And at the same time, real yields creeping higher, Matt. Negative 87, negative 88 basis points is where we sit. Yes, still negative, but if those continue to climb higher, we could eventually start seeing that weighing on riskier assets, Matt. What are you watching?
Yeah, well, I'll tell you what. I'm watching 10-year break-evens as well, and you have the 10-year there. I would say maybe we want to put up the 5 years because if the 10-year break-even's coming down, you might notice the 5 years creeping up. It's at 232 right now in the U.S. I'm looking at a comparison, though, between the 10-year break-evens of the U.S. and Germany, and you'd see the same picture pretty much if you look at any of the other durations. It just continues to come down. So right now it's at basically all-time low because there's so little inflation expectation in Germany. We have 10-year break-evens here at just about 1%, 5-year break-evens at just about 0.88. So they're drastically different numbers. Germans can expect, and of course Germans hate inflation more than pretty much anybody else in the Western world, but they certainly are expecting much less of it than Americans are.
Yeah, Germans have a very, very long memory about inflationary pressures 20, 30 years ago. Now, still with us, well, actually joining us this morning, I'm jumping the gun there, James Athey, Investment Director at Aberdeen Standard Investments. James, when you look at Treasury and actually the move in Treasury, will it shake out some of the riskier assets?
Yeah, I think Kelly made the right point there, which is what we've seen most recently is that finally the rise in nominal yields is starting to have an impact on real yields. We first saw it at the very long end of the curve. 30-year real yields have been rising for a little while now, and increasingly in the last week or so, it's having an impact on 10 years. And if this sell-off continues, ultimately you would expect that to work its way down the curve. And one of the main pillars really for equity investors, multi-asset investors, to believe that buying equities at any price is still a rational long-term investment strategy has been this notion that yields or real yields will stay very low and very supported forever, and they can use ridiculously low discount rates to generate high PVs for those equity prices. So definitely that assumption is being challenged at the moment, and also ultimately it's the market challenging the Federal Reserve's resolve. Words are not going to be sufficient. If this flexible average inflation target framework is successful, it sows the seeds of its own destruction unless the Fed is prepared to ease into a strengthening economy.
But James, I know, but at the same time, you know, we had that U.S. initial jobless claims that were worse than expected, so it underlines the fragility of the economy. You know, we still need to follow the real economy and therefore just vaccinations to understand what real yields do.
Wow, I mean, I wish that was the case, Francine. I'd like to agree with you strongly and say that's exactly what we should be doing, but this is not a market that particularly cares about reality, certainly not spot reality. The time horizon that this market is prepared to use is one which is expressly chosen to justify pre-existing views. So if the vaccination program is a slower rollout, if virus mutations occur, which they have, then merely the market says, well, rather than looking at it 6 months into the future, I'll look 9 months into the future. It will be good then, and we can carry on with this trade. I would strongly share the observation that underneath all of these market moves, you still have incredibly fragile, incredibly unhealthy, and incredibly scarred economies, which really, left to their own devices, would be incredibly prone to dramatic weakness.
Yeah, absolutely, James. I was talking to one of your colleagues earlier, Stephen Major from HSBC, and he says he sees a lot of red flags in the bond market, especially at the very short end, such negative nominal rates. He says signals to him that something's kind of bubbling under the surface. Do you agree?
Yeah, absolutely. I mean, Stephen Major and I have probably shared views on the bond market for more often than we've disagreed. Unfortunately, being a bond guy, you're kind of accused of economy bearishness, bullishness, and so those views can be discounted. But yeah, absolutely, I think the bond market is better at sniffing out what's truly going on under the hood than some of the risk-facing markets. I think actually what's driving bond yields higher really is technical flow, momentum players, systematic flow, and a positioning purge. Again, I don't think this is a reassessment. And ultimately, the negative real yields are telling you that there's weakness out there.
Yeah, but what are the bond markets specifically worried about? I mean, you talked about the underlying weakness in the economies, and yet we see risk assets just continuing to rise. Are they telling us that maybe a bubble's about to burst?
That's difficult. I think if bond markets genuinely thought that there was a bubble, an equity bubble about to burst, I think we wouldn't be seeing nominal yields rising in the way that we have done in the last few days. I think actually what bond markets are worried about is inflation. Let's be honest, as a fixed interest investor, certainly one with prevailing very low yields, in some cases ridiculously low yields, even a small dose of inflation can be detrimental to your real return. Right. And actually what we're seeing, certainly in the US, we're seeing both arms of policy really acting and speaking in quite an irresponsible sounding manner. And I think that historically that's always been a concern for bonds. You know, bond vigilantes have been crushed by the steamroller of Fed policy, but the Fed at the moment is talking a lot and not doing much. So maybe the vigilantes may return.
James, we focus so much on the impact the bond market and higher yields have on equities, but what about the dollar? The prevailing narrative, the consensus is dollar weakness in 2021, but in theory, higher treasury yields could boost demand for the dollar. What's your take on that?
Yeah, I agree, Kaylee. My view from the back end of last year into the new year was that the market's consensus narrative cross-asset was not particularly robust and was not a very stable equilibrium, at least in part, if not largely, because of that exact dynamic that you talk about. The idea that you have a US-specific, idiosyncratic positive growth shock in a world of meager growth and certainly meager bond yields, and that pushes US equities up and outperform versus global equities, and that pushes Treasury yields up, Treasuries underperforming versus global yields, and somehow that would be dollar negative. There aren't many, if any, periods of history where really that's been the case. So I do think that the tailwinds for the dollar, the headwinds for those dollar bears are material at this point, because it does look like a world of US exceptionalism, to quote what is now a cliche. And I think that battle is going on. We're seeing the dollar oscillating without really going anywhere. Ultimately, the market still thinks the dollar should go down for somewhat spurious reasons, I think, about current account deficits and inflation dynamics.
Thank you so much, James Athey there from Aberdeen Standard Investments. He stays with us, and we're just getting some breaking news out of China. Now, we understand that China may actually ban some of the rare earth technology exports on security concerns. But throughout the week, we were looking at some of the press reports out there that China was looking at possibly targeting rare earth exports to hobble the U.S. defense industry. So we'll see what that means for future U.S.-China trade relations. And we'll, of course, look at what that means for rare earths and some of the things where rare earths go into. Now, coming up a little bit later today, Mohammed Ilarian, Gramercy Fund's Management Chair and Bloomberg Opinion columnist. That's coming up, that interview at 9 a.m. in New York, 2 p.m. in London, and this is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
You know that tech stock we talked about? I picked up 500 shares.
You get in at a good price?
Oh, yeah.
Schwab saved you how much?
With Schwab Order Execution Advantage, you get price improvement on 92% of orders and commission-free online trades.
I'll take care of this.
Are you getting complete price transparency? Expect more from your firm. Schwab, the better place for traders.
Sarah, did you know Geico could save you hundreds on car insurance and a whole lot more? So what are you waiting for? Captain Ahab to help you find a parking spot?
There she blows! Well, loading zone, darn it. Pull hard to starboard!
Too small!
Seriously? Because it... follow him! Steady, steady... No! Thunderation to the northern lot, where there are parking spaces as big as whales!
Geico. See all the ways you could save.
It's either the assurance of a 165-point certification process, or it isn't. It's either testing an array of advanced safety systems, or it isn't. It's either the peace of mind of a standard unlimited mileage warranty, or it isn't. For those who never settle, it's either Mercedes-Benz Certified Pre-Owned, or it isn't. The Mercedes-Benz Certified Pre-Owned sales event now through March 1st. Shop online or drop by your local dealer today.
This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Now, over the last couple of minutes, we just had some breaking news. We understand that China may ban some rare earth technology exports on security concern. Now, this ties back to the story of rare earths. There were earlier reports that they could actually ban some of the rare earths themselves. This has not been confirmed, but we know that China is reviewing their policy on rare earths. Remember, 80% of worldwide rare earths come from China, but they also have technology which is far superior for refining the rare earths, and that's really the key here. Still with us, James Athey from Aberdeen Standard Investments. I guess, James, China could have been much more aggressive. For the moment, they're just thinking about, stopping the export of the technology, so they still have a stronghold on it. But is U.S.-China still going to be the big unknown for the world economy under the Biden administration?
Yeah, I mean, this whole situation with rare earths, I mean, off the top of my head, I thought the number was actually larger than 80% in terms of China's control. And this is something which has kind of been out there in the ether for quite some time. It was always a risk because, as you've kind of intimated there, rare earths, this bunch of quite rare materials do act as an input into, a huge number of manufacturing processes. And a lot of it is the kind of technological stuff that we like to use these days. So this was always a risk. We saw a headline earlier in the week or last week suggesting they might even ban exports of the rare earth materials themselves. Now it seems to be citing security concerns to not export the technology. That almost feels like a bit of a sly dig, as security concerns have often been used, certainly by the last US administration, to engage in restrictive export practices.
Yeah.
It's just another shot across the bows, in my opinion, in this ongoing spat. I think Biden, because of the nature of Congress at the moment, he can't veer too far from this sort of confrontation with China. Sorry, Matt.
Well, he can spend money. Joe Biden could spend money if he wants to start refining our own rare earth metals. We have them. We just don't pay to set up the factories. To refine them, and if we really want them, we'll do that. I'm more interested in your statement about the bond vigilantes coming back. Do you think that's a reality in the near future? And if so, I mean, last time around they were pushing up 10-year yields to like 12, 13, 14%, right? How high do you think yields could go?
Right, so this gets to the very nub of the paradox, ultimately, of what central banks are trying to achieve here, right? We've known for a long time, some of us, many of us have known for a long time, that there's this disconnect between financial markets and the real economy. And nobody tries to diagnose what's wrong with the economy. We just throw stimulus at the problem. Now we've got both arms of government policy, central bank policy and fiscal policy firing at the same time. And there is every chance that this does have a more positive growth and a more positive inflation impact on the real economy. And really, the only thing that's been able to keep markets in such a ridiculously expensive place across the spectrum throughout the last 4, 5, 6, 7 years has been this idea that inflation is low and therefore central banks can keep foot to the floor in policy terms. If just for a second that assumption is questioned, then there has to be a major repricing. And if that is because inflation pressures are not only rising, but starting to feed off themselves in a way which we know from history can be self-fulfilling and can become quite rapid, then obviously bonds are not the place to be. So this is not my base case. But I certainly think that if the market wants to run with the inflation expectations, it becomes a big challenge for central banks in the near term.
Yeah, well, it's something you got to hedge against, I'm sure. James, I look at debt go when I'm trying to sort of divine the differences between what bond vigilantes would be able to do now and what they could do last time they came into existence. If you look at debt go, you'll notice that the Federal Reserve owns a ton of debt, so do all these central banks. And that's, I think the big difference is that you have another major buyer in town that you didn't have in the 80s.
Of course, right? I mean, this is ultimately financial repression. The idea behind financial repression is that you're going to offset the market's reaction to this rise in inflation and growth expectations. The problem is that the Federal Reserve's buying policy is to keep buying constant at the current pace. And at the moment, the number of people who own bonds and want to sell them seems to be far greater than that Federal Reserve buying pace. And while there is demand along the way, and we know about structural demand for fixed income securities, and that is showing itself, you speak to the street, there are buyers out there. At the moment, the flow from the sellers is overwhelming that. And where the right price, where the right yield is currently to equalize those is difficult to say. And again, market structure, as we see in the equity space, market structure has changed dramatically. Not everybody is a fundamental investor. Not everybody is trying to do what I'm doing and derive expectations around interest rates and inflation into the future. Many are reacting to price signals, systematic accounts, momentum followers. And these guys can be very, very powerful on a day-by-day basis. And so there are potentially forces here which really could cause fractures in financial markets, and the central banks therefore have to make a decision. Is our policy here to deal with the real economy, or is it here to deal with problems in the financial markets which are ultimately of their own creation?
James, thanks so much. James Athey, their investment director at Aberdeen Standard Investments. Now, coming up a little bit later today, of course, we'll take stock on the U.S. economy with Ellen Zentner, Morgan Stanley chief U.S. economist. That conversation, 6:30 a.m. in New York, 11:30 a.m. in London, and this is Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Here's AJ.
When are you going back into the office?
I don't know, Dad.
Well, we have a safety net. We'll be okay, right?
This is Decision Tech. Find a stock based on your interests or what's trending. Get real-time insights in your customized view of the market. It's smarter trading technology for smarter trading decisions. Fidelity.
My music is powered by the latest technology. To get the crowd going in the club, or in my Jaguar playing the track for the first time. It's always one touch away from an amazing experience. New F-Pace, how Jaguar makes an SUV.
For great offers, visit your Jaguar retailer during the Impeccable Timing sales event.
PNC Bank believes that if an app can help you track your pizza,
Come on, Cody, where are you, buddy?
then your bank should have the technology to help you track your spending. Virtual Wallet was designed to change what people expect from their bank. Easily see what's free to spend and where you can save so you can budget even better.
Okay, he's got to be close. He's 6 blocks in the other direction. Make a left, make a left, make a left. He made a right again.
Virtual Wallet for digital banking. One way we're helping to make a difference at PNC Bank.
So you're a small business, or a big one. You were thriving. But then, time to think, plan, pivot. How do you bounce back? You don't. You bounce forward with serious and reliable internet, powered by the largest gig speed network in America. But is it secure? Sure, it's secure. And even if the power goes down, your connection doesn't.
So how do I do this?
You don't do this. We do this together. Bounce forward with Comcast Business.
This is what community looks like. Caring for each other. Protecting each other. And as the COVID vaccine rolls out, we'll be ready to administer it.
Change is all around us, shaped by technology and human ingenuity. We can make it work for you and your business.
There is a growing bifurcation today between companies that are truly growing above GDP and those that simply aren't. Without the right type of growth, a good value is essentially just a bad investment.
In principle, we try and look through that noise, try and identify the portfolios that will continue to perform well even after this cycle is over.
We could already see a demand recovery in the second half of 2020, led by an extremely strong Chinese market for us, but also in Europe and in North America. Things were picking up towards the end. This is, in our case, driven by a phenomenally attractive product portfolio.
That was some of my exclusive interview with the CEO of Daimler, Ola Källenius. Now, let's get the first word news for you. The U.S. says it's willing to meet with Iran to restore the nuclear deal. It's a first step towards easing tensions that rose steadily over the last 4 years. Donald Trump pulled the U.S. out of the Iranian deal in 2018. He also imposed sanctions that hammered Iran's economy and infuriated other world leaders. Iran says there must be relief from sanctions before there are any talks. Republican Senator Ted Cruz has returned to Texas after a highly criticized family trip to Cancun, Mexico. Cruz jetted off while Texas was dealing with widespread power outages. He told reporters he did it because his daughters were cold, but he says it was obviously a mistake. In the UK, a landmark court decision that threatens Uber's business model. The Supreme Court said that Uber drivers were workers entitled to rights like a minimum wage, holiday pay, and rest breaks. The ruling is the end of the road for Uber's 5-year fight over the status of its drivers in the UK. And it actually is kind of the opposite, Francine, of what Californians just voted for. Uber workers getting rights in the UK that they're not getting in progressive California.
Yeah, so this is not only about the Uber drivers, because this goes, you know, in the UK, it's a landmark decision that will probably touch anyone who works in the gig economy. Suddenly you have rights.
Good point.
You need holiday pay. The only question I would have is actually how much will, I think the initial 25 drivers that bought this landmark case in 2016, how much will they get paid?
And to the point about California,
well,
I mean, that fight's still not over. There's still lawsuits flying around this. To Francine's point, the entire rules around gig workers are probably going to change, if not now, at some point.
Coming up, Ian Shepherdson on the economy.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance, the early edition. I'm Francine Lackman, London, Matt Miller in Berlin, and Kaylee Lyons in New York. Now, there's a lot going on, of course, with that rare earth story. We saw that Uber losing the UK top court, meaning that all of their gig workers, Matt, and you were talking about California, in the UK, they're now workers, which means that they get extended pay, they get breaks, and of course, they get some kind of support from the government if they lose their job.
Well, and you know what? This makes me happy for black cab drivers in London because they have long decried the unfair competition in the market. Of course, a black cab costs a heck of a lot more than an Uber because they have a lot more costs to pay, right? And they're part of a company. They've got to follow regulations. Uber drivers don't. And these black cab drivers also have to learn the knowledge. They have to spend years toiling away. They're like the salt of the earth when it comes to British people. So I'm glad, you know, they get a little bit of a break here.
You know what, Matt, I was speaking actually to one black cab driver who was saying that, you know, there's no work at the moment in London, because what I didn't realize, it's not the Londoners that take the black cabs, it's the tourists, and they make up 85% of their workload. So it's a tough time for taxis, Kaylee.
Yeah, I have been a tourist that has taken a black cab in London just for the sake of taking a black cab. I'm with Matt. I think they're just so cool. I would note that Uber shares in the pre-market off the back of that decision are down around 3%. That isn't the case, though, broadly speaking, for the equity market. We are seeing futures pick up as the session grows older. Specifically, Russell 2000 futures really roaring ahead, up a full 1% at this point. NASDAQ futures up by about 0.4%. Yields column unchanged. The 10-year sitting right around 1.3%, still much higher than where we started the week. I would note the dollar is weaker, mixed though in the G10 space, but it isn't giving a lift to some commodities like gold, which is lower once again today. Matt, I know, I'm sorry, it is your precious gold, but it really has fallen out of favor so far in 2021. It's its worst start to a year since 1991. 3 decades, not providing any kind of inflation hedge, not getting a bid for that inflation hedge, instead higher yields and a not as weak dollar as maybe some were expecting weighing on gold. You're also seeing crude lower by about 1.7%. Part of that is the Iran story with the Biden administration. Potentially removal of sanctions could bring more oil onto the market, but also the easing energy crisis in Texas. Now concerns about demand rather than supply. And I just have to point out copper futures in London up above $8,700. That is a 9-year high. Now, Goldman Sachs says part of that is just the supply shortage is boosting prices. Also, China coming back online after the Lunar Year holiday. Plus, Dr. Copper probably trying to send a signal about growth and reflation expectations, Matt.
Yeah, Dr. Copper, always important to pay attention to. In terms of gold, you know, the problem is, part of the problem is the rising yields on the long end. On the short end, meanwhile, they're going negative. I've got a great chart that shows what this kind of steepening does to the economy. In the white here, you see 2s, 10s, and in the blue, you see consumer confidence expectations. You'll notice whenever there's a steepening, in these red shaded areas are recessions. Whenever there's a steepening, the consumer confidence follows almost immediately right along with it, and then we come out of a recession. So maybe that's just about to happen here, Fran.
Great charts. And actually, let's talk about those charts with Ian Shepherdson. He's founder and chief economist at Pantheon Macroeconomics. Ian, when you look at the U.S. economy, so I know we're looking at productivity, we're looking at slack, we're looking at financing conditions. Overall, if you look at the real economy, you know, how difficult is it to get a clear picture, given some of the jobless claims? They're up, they're down. You know, is the growth going to be sustained?
Yeah, if you step back from the noise, I think what you see now is an economy which is mostly in the deep freeze. I mean, there are some exceptions, like the housing market, which has been very strong. And of course, we had that stimulus boost to retail sales in January. But Yeah, as you say, jobless claims are high and sort of bouncing around the 850 a week level, which is still way higher than it was even at the very peak after the crash in 2008. So we still have some really big, deep problems in the labour market. And of course, a large bit of the services economy is still closed or running at very reduced capacity. And that's where most of the spending is, or right now isn't. So we're still, I think, waiting for the big unloosening of restrictions from COVID, which I guess will come sometime in the spring. But now we're still pretty frozen.
And Ian, we're still waiting for that huge stimulus. Janet Yellen once again saying, look, she's committed, despite what we saw in stocks and despite what we saw in some of the PNI numbers as well. Is it too large, actually? Could it create, you know, the bad kind of inflation?
We'll only know after the event. I mean, if we get out of COVID jail in the spring and everything goes really well and very smoothly and there's no backsliding, then by the end of the year, we'll be looking back and saying, hey, that probably was a bit too much. If, though, for example, the US suffers an outbreak of the UK variant, the B117, which is present now right across the US and has the potential to take cases back up again, if that happens and the reopening is delayed by a few months, then we'll be looking back and saying, hey, being cautious and doing more was the right thing to do. Given from a political perspective, of course, it's easier to get more money once than going back for a second round, which would be much more difficult and take time, of course, as well, time that would be lost. So I understand Yellen's position and the administration's position, but I think that we have to be upfront and say there is a non-zero risk that does turn out to be too much, and we are facing an overheating economy late this year, early next year. But I've got to say right now, that would be a nice problem to have.
Ian, at the beginning of the show, I was showing a chart that illustrated the difference between inflation expectations in the U.S. and in Germany. They're almost non-existent here, and in the U.S., of course, they're healthily, well, break-evens are healthily above 2% wherever you look. Is that because of U.S. stimulus, you think? And if the Europeans were to put more stimulus into the system, would they be able to get inflation up, which, of course, the ECB's been trying to do for so long?
Yeah, and the Eurozone, of course, faces structural difficulties that the US doesn't have. Plus, of course, the stimulus has been much bigger in the US, the monetary response has been bigger, and the progress on COVID right now looks to be faster in the US. I mean, the level of cases is still quite high in the US, but they're dropping very, very quickly now. Whereas Europe, you know, the vaccination program is only just getting underway. So markets are looking at this reflation story and saying pretty much every element of it is more powerful in the US than it is in Europe. If there was to be a sudden announcement of a more aggressive fiscal response in Europe or a more aggressive monetary response or both, then that would make a difference at the margin. But I think this sort of gap we've got here between inflation expectations across the Atlantic is very likely to persist because the US right now is throwing pretty much everything but the kitchen sink at the post-COVID economy. And we can all see the pile of cash that's sitting on the sidelines and just waiting to be spent as soon as it's safe to do so. And it'll be earlier in the US because the vaccination rollout has been so much quicker.
Well, the vaccination rollout has been quick, not just in the U.S., but also in the UK. So what about the difference between Europe and the United Kingdom? We saw pretty dismal retail sales numbers out of the UK today. What is your growth expectation for the UK specifically? And do you think the BOE will, in fact, have to use negative rates at some point?
Yeah, I think that's unlikely because I think the UK, as you say, is a long way down the vaccination road, substantially further ahead even than the US, and likely to reach herd immunity in the spring, and therefore the economy ought to rebound quite aggressively. I mean, the retail sales numbers were obviously crushed by the lockdown. The UK has been in an almost complete lockdown since January 4th, so the whole month of January pretty much was affected by the lockdown, and February will be grim as well because the lockdown is persisting right through this month, and we'll find out Monday whether it will be released in part in March. But we're not going to see any big rebound. You know, it's the two events, the economy and the COVID, are intertwined. They can't be separated. So until the COVID restrictions can be released and people feel safe again and the infections are down, then the economy remains very weak. But the potential for a rebound in the UK is probably somewhere between the US and the Eurozone. So, you know, metaphorically and geographically and economically, you know, the UK sits between them again.
Ian, pound surging to 140 for, you know, $1.40. Like, I feel rich. I know you do too. Ian, talk to me a little bit about US-China. You know, how does the Biden administration deal with, for example, all of the concern regarding the rare earths?
Well, this is a difficult one because there's no way the US-China relationship can go back to the way that it was before the Trump administration. China's behavior has been, in many different aspects, has been really quite egregious over the last few years, and the US is looking with alarm at China's adventurism in the South China Sea. It's looking with alarm at its behavior in Xinjiang, and there's a whole host of problems which at the end of the Obama administration weren't really there. So we can't have a rollback of all the stuff that Trump did on the trade and the geopolitical side. The Biden administration, so far has been completely focused on the COVID question. So we haven't really seen any clear indications of what they're going to do with both trade policy against China and also what they will do on a sort of geopolitical perspective in terms of dealing with China's adventures in the South China Sea. So we've got a real big bunch of open questions here, and at the moment very little clarity on what will happen. But I do think that we're not going to go back to any sort of cozy relationship. Xi Jinping's leadership of China has been really quite aggressive, and Trump, of course, accommodated that. But I think the Biden administration will be pushing back quite hard. At this point, though, I just don't know when and what specific measures they'll be taking.
Ian, thank you so much. Yeah, I wonder whether, pound will go to 150, then we'll be really rich, but we still can't go anywhere. Ian Shepherdson there, founder and chief economist at Pantheon Macroeconomics. Now coming up, Joe Stiglitz, Columbia University economics professor and Nobel laureate. He's been pretty interesting when it comes to Euro and European dynamics. It'll be interesting to get his thoughts on the stimulus and what Europe needs. That interview, 10 a.m. in New York, 3 p.m. in London, and this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is Bloomberg Surveillance Early Edition. I'm Karina Mitchell in the principal room. Coming up later today, Ellen Zentner, Morgan Stanley chief U.S. economist. This is Bloomberg.
Securities put the restrictions in place in an effort to meet increased regulatory deposit requirements, not to help hedge funds. We don't answer to hedge funds. We serve the millions of small investors who use our platform every day to invest.
We had no role in Robinhood's decision to limit trading in GameStop or any of the other meme stocks. I first learned of Robinhood's trading restrictions only after they were publicly announced.
It was must-watch TV. I know many of you watched it. I really enjoyed watching it. Now, the main characters there of January's unprecedented retail trading frenzy faced U.S. lawmakers in a hearing yesterday. So to bring us all of what we heard is Sonali Basak, Bloomberg Wall Street reporter. Sonali, I think probably who was most important or who captured really my imagination was the Robinhood founder. And he went almost as far as apologizing. Will he actually change anything on how his trading platform is run?
It's a great question, Francine, because the entire business model of free trading did come under attack yesterday, particularly by Alexandria Ocasio-Cortez. But at the same time, many representatives had asked the question about whether, if the clients are not paying, are they the product? And are there problems behind the practice of selling your trades to major market makers, to the likes of Citadel Securities, though we know there are many others?
I thought that was more of a statement. I mean, don't we know that the clients are the product? Isn't that how the business model works? And I wonder what AOC was getting at. I was trying to kind of understand where she was going with the question, and I wasn't quite following. Did you get it?
Here's the thing. Yes, because the question here is, are the clients getting the best deal? In theory, payment for order flow and selling your trades to market makers would get you the best execution by routing more trades to those market makers, and them in turn making it possible to do free trading. But at the same time, he was asked yesterday to provide evidence that the clients were getting the best deal here, and he fell short of doing that. So now the entire business model is under question. And the other big thing about this is the other brokers, right? They have big diversified business models. Robinhood, now we know, generates a staggering more than 50% of its revenue from payment for order flow. That means its business model, so much of it is predicated on this business of selling the trades. That is not true.
Hang on, can I just, Sonali, can I just ask, so is the idea Congress wants people getting free trades to get better service than people who pay a broker for trade? Is that the idea?
Congress just wants the retail trader to have a couple things. They want clarity on whether they are actually getting the best deal here. We don't know that in a finite way. That's one thing. The other thing is they want retail traders to have information at their hands that they can use to make the right decisions. Right now, you trade on Robinhood. You may be able to do so on margin. They were concerned about that. And you're getting your information from Reddit. So how do you know that you're giving the people the tools they need to succeed as they enter the stock market, in many cases for the first time?
So what can Congress actually do about it? What is most likely that they will do? Maxine Waters was signaling this is far from over. We're going to continue talking about this. What's the end game?
Right. Well, payment for order flow and disclosures around the relationship between Wall Street and these brokerages is one very simple thing, for one thing. The other thing is this T+2 idea was squandered a lot yesterday. This idea that trade settlement times can be collapsed. That's something that Vlad Tenev had said that would have really helped in that middle period of volatility where they had to post a lot of collateral. Ken Griffin, who's the majority owner of Citadel Securities, said that there could be issues with doing such a thing, that would really make sure that all the stars had to align and the industry is not quite ready for it. So we know that that's not an immediate answer to this problem. The other thing, Kaylee, is the fact that Robinhood didn't have enough collateral on hand. Can they force the brokers, especially these new companies, right? Every fintech in the world was watching what happened yesterday, to post more money and have more money on hand on the onset.
Sonali, thanks so much. Roaring kidding, not a cat. Sonali Basak, a Bloomberg Wall Street reporter with the very latest on GameStop. Now, coming up on Bloomberg Surveillance, Representative French Hill. He's a Republican from Arkansas. That's at 8 a.m. in New York, 1 p.m. in London. This is Bloomberg.
These solar arrays that we're going to install are going to be about half the size of the existing solar arrays that we have on the International Space Station. But because of the advances in technology over the years, they're going to provide about twice the power in just half of the area that the existing solar arrays cover.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This is Bloomberg Surveillance, early edition. I'm Francine Lackman, London, Matt Miller in Berlin, and Kaylee Lyons in New York. Now, when millions of Texans lost power, Republican Governor Greg Abbott blamed clean energy for the greatest forced blackout in U.S. history. But lost in the narrative is the reality that renewable energy has been a boon to Texas. In a new Bloomberg opinion piece, our editor-in-chief emeritus, Matthew Winkler, writes about where the fastest growing source of new jobs are. Matt Winkler, thank you so much for joining us. How many jobs will Texas actually benefit because of this clean energy?
It's great to be with you, Francine. Well, it's early days is really what it is. But if you look at not just Texas, but really everywhere in the U.S., the fastest growing industry or sector after e-commerce, and we all know what e-commerce is, that's Amazon, Apple, and so forth, is renewable energy, and it's ahead of everything else. And what does that mean? I mean, that obviously is wind turbines in Texas, and those jobs, in fact, have been multiplying almost exponentially in the past 5 years. But it's also solar, and it's also biofuels. It's all kinds of things. And the reason is there's a convergence of the consumer, people's preferences, and the, if you will, corporate America. And if you look at where corporate America is hiring, look at the Russell 3000, which is big and small companies alike. Most of the jobs, the new jobs that we're seeing are going to what we call alternative energy or renewables. And that makes sense just because we all recognize that climate change is an existential threat. And if you think about business as every problem is an opportunity, here's the opportunity.
Are we going to see, though, after the recovery from the pandemic, a rebound in jobs in gas, oil, and coal? Or is that, job loss that will just go?
Well, it's very interesting, that question. And I, of course, do not have the answer, nowhere near as clairvoyant as some people are. But there is somebody who is, I think, pretty farsighted. And she is Cathie Wood, and you know about her. She has been one of Tesla's biggest champions. And when we put that question to her, actually, at the beginning of the year, and her investing is, global in scope, she said the oil industry itself is just not going to recover to where it was, at the mid-tens, if you like, in this new century. It's not going to happen. So I think her track record speaks for itself. She's been extraordinarily successful. And so the answer to your question, if it's coming from, go ahead, Matt.
Why are Greg Abbott and the other sort of establishment industry people, establishment politicians that we talk to on this program so short-sighted? I mean, surely follow the money is one of the greatest lessons I ever learned from you. And the money is eventually going to come from Elon Musk, right? The money is eventually going to come from those 3,000 small and mid-sized companies that are going to be hitting the public markets in a wave over the next decade.
Yeah, I mean, look, there's a funny thing with politics. Politics, unfortunately, is too often proud to be stupid. That's politics. And what you're talking about is, capitalism. And capitalism is always trying to find, the next best thing wherever it is, and that's what we're seeing with the renewable energy industry, and that's what climate change is all about. And so, the states that are favoring, if you will, policies that are dealing with climate change are the ones that are doing best. And by the way, even with all its problems, California is far and away ahead of Texas in that regard. And so you got to believe Texas at some point is going to be dragged politically, kicking and screaming, into the 21st century to recognize that renewable energy is a growth industry.
Matt, thanks so much. Matt Winkler there, Editor-in-Chief Emeritus, with a great piece on, of course, the Texas blackouts, forced blackouts, and what they mean for job creation and this, I guess, uneasiness in certain parts of the Republican Party with clean and green energy. Now, Matt and Kaylee, I know we're looking at the weekend, and Matt, you wanted to talk about Porsche and the fact that there's now rumor that there may be a 25%, listing of Porsche. Like, is a Cayenne the next thing?
Well, or the Taycan. Winkler would drive a Taycan. It's their electric version of Tesla's Model S. The interesting thing is Volkswagen alone is only worth about $90 billion. And Porsche, which is in Volkswagen, is worth about $130 billion. So it would be amazing if they could spin it out.
It's a little bit like what happened with Ferrari. Coming up next, Steve Whiting. This is Bloomberg.
Very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast. And it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being in almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
market that will probably last for a long period of time has begun.
We've started to price better news for 2021, but we've got a long way to go.
We are about to throw a gigantic amount of stimulus on a market that's about to reopen anyway.
When households have resources to spend, they ultimately will.
The bigger the stimulus gets, the less money there is for anything else.
Every trade is so correlated right now because every trade is being driven by negative real yields.
At the core of it, high yields are predicting faster growth.
This Fed is different, and we shouldn't try to fight the Fed in this environment.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg TV alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro with futures positive 13 points on the S&P following the longest four-day week ever. Tom Keene, we're almost there.
Yeah, we're almost there.
Almost done.
I mean, it's a really, really interesting, John. I'm going to go to Ian Shepherdson about 20 minutes ago with Francine Lacroix and the team, and he nailed it. It is an overheating economy. That's the expectation out. And you see the markets in some begin to adjust to that this morning. These are not overheated, but these are markets ready to go.
Dr. Copper, Tom, starting to scream. Copper up in London by 2.5%.
Yes.
Goldman looking for 10,500 over the next 12 months.
I looked at the Bloomberg Commodity Index, and it is linear, and it's got some convexity, some acceleration, John, there, of that blended commodity index showing a global bid on.
Lisa, we got to push forward to next week as well. A lot of Fed speak coming up over the next 7 days.
Yeah, Fed Chair Jay Powell going to be speaking, but also Chair Yellen. Well, I say Chair Yellen, and yet now she's the Treasury Secretary. And I got to say, Tom, you're talking about overheating, and that implies that the economy is going to run too hot. And I think it's really interesting that yesterday in a CNBC interview that Janet Yellen said that, hold on a second, that Janet Yellen said that the risk of doing too little is greater than the risk of doing too much. She doesn't see the sort of fear of an overheating economy and runaway inflation taking anything away.
What's going to matter here, and it's something for Friday and for our weekend reading, John, what about looking at what corporations will do? How will corporations adapt to what they've been handed?
Hopefully, Tom, they'll invest. Hopefully they will invest. But Lisa, aren't these politicians, these officials, these central bankers conditioned by the previous cycle? They made mistakes. They don't want to make the same ones again.
Yeah, the mistake has always been underplaying the fiscal response, underplaying how long monetary stimulus stayed in place, the idea that inflation did not take off. And yet this time people are saying it is going to be different given the dual impulses of both the fiscal stimulus in addition to the monetary stimulus coming together and fostering a very different environment.
So lucky to have Lisa with us just to find that little bit of darkness out there.
How is that darkness? That's just reality.
Just that little bit of darkness. Let's get to the price action. We look like this morning, this Friday morning. Good morning to you all. Equity futures are pushing high. You wouldn't know it. Up 12 points on the S&P. If we're down, Lisa's got a problem. If we're up, she's got a bigger problem. Up a third of 1% on the S&P. In the bond market, yields are higher. There's your break of 130 again, Tom Keene. 130.59 on a US 10-year. And crude back in. $59 and about 36 cents. And Lisa, a conversation maybe between Iran and President Biden on the cards.
Yeah, possibly some sort of rehash of the nuclear deal that was scrapped under President Trump. But I gotta say, just talking about gloom, there is a question about gloom versus reality, right? I mean, how much do we just capitulate to this idea that everything is rosy, and how much do we look at the on-the-ground reality, which has not been moving that fast? And that's what we're going to be getting today at 9:45 a.m. We're going to be getting a PMI data for both manufacturing and services. We have been seeing a massive recovery in the manufacturing PMIs. We are expecting that to stall out a little bit, and we're also starting to see some, to use Tom's word, stasis in the services side. But again, people don't seem to care about this data. They are looking forward to what happens after we get stimulus and after we start to get things reopened a little bit. Then at 10 a.m., I'm actually very interested in existing U.S. home sales because we've seen prices of homes go up so dramatically. The price of lumber reaching an all-time high. John, it is up 30% year to date. Year to date. Wow. It's insane, right? So we're going to be getting probably a slowdown in the number of home sales just because the affordability issue is coming up to the fore. And then at 3:10 p.m., Joe Biden will be speaking at a Michigan plant for Pfizer, talking about vaccinations. Very curious to see whether the U.S. is going to more dramatically shift their stance. John, you've been talking about this a lot, the idea that in the UK, they've been giving one shot to individuals and trying to get into as many people's arms as possible, and they're seeing protection from that. A new Israeli study showing that healthcare workers had an 85% reduction in symptomatic cases after receiving the first Pfizer-BioNTech shot, leading to some credence to the idea of getting more shots in more arms more quickly.
Lisa, on the vaccine front, and Tom, this is so important because we've crunched the numbers here at Bloomberg, and it looks like we're in for a vaccination surge in the coming weeks and months in the United States.
I look carefully at the trends, and I look mostly, John, at hospitalizations because that's what the pros tell me to look at. It is linear, it is good, and John, we're really hearkening, even in New York City, back beneath where we were in the spring of last year. John, I do want to mention this because Steve Whiting is so important on this overheating aspect. I'm watching right now into the weekend the Chinese renminbi. It has been stasis. It has been stuck at, a very strong level, 6.45, but it's screaming, trying to break through that to new yuan strength.
Let's get to Steve now. Steve Whiting, Citi Private Bank Chief Investment Strategist and Chief Economist, joins us now. Steve, let's just start with the title of your research. In fact, it's a subject in your research that you've been following, and I think everyone is following the same theme. Where do I get real returns from? Where do you go, Steve?
Well, there are high-risk options and low-risk options. You want to start with the lowest risk option. It's Treasury inflation-protected securities, where you're guaranteed the CPI, which is not, in fact, the Federal Reserve's inflation target. It's actually a measure that's closer to a fixed weight basket, and you'll get the annual return of inflation. Unfortunately, over a course of 10 years, let's say if you buy a 10-year tip, you'll get back 90 cents on the dollar on your principal plus inflation. So that's a really low risk, but fairly guaranteed version of this. And then there's all sorts of other things that you can do. If you're interested in the bond market, you'll have to take a substantial amount of credit risk. If you're thinking about inflation, if you're thinking about it, it's mostly going to be inflation of revenue for companies. And it'll be the equity market and equity income that will get you some protection from inflation, at least on the earnings front, if not the valuation front.
I've repeated this line from Bob Michael of JP Morgan Asset Management in the last 24 hours a couple of times. I'll do it again. This is what he had to say to us. Someone to wait until there is a meaningful correction. I keep telling them that everyone on the planet is waiting for that to happen. Valuations occupy everyone's time and effort. Nobody likes them here, but that's the reality. Steve, does that resonate with you?
Well, I think it's in some respects a little bit better than that. We are going to have a very strong EPS recovery. Last year was a 19% gain in global share prices. Let's look back at 2009. It was a 39% gain. Now, valuations are different. Interest rate levels are different. But we then went on to have share prices globally, returns, rise in 9 of the next 11 years. So again, just thinking, recovery is discounted, I'll stop there, I'll wait there. That tends to be a very big mistake that people make. And what we can see, again, by missing out on the strong returns of just staying invested for growth and development in the economy over time, these can sap portfolios, double digits.
Steve Whiting, thrilled to have you here because you link profits better than anybody I know in economics, and I know they've dragged you over to do chief investment strategy. I want you to talk about the economic profit picture in the core GDP equation and what it's going to do, how it's going to devolve over to corporations. From what I see, we're going to see a massive lift. Is it going to go into investment or is it going to go into shareholder return?
Well, I think you'll see shareholder returns first and then investment later. And at that point, returns in financial assets will slow down. We're not expecting, again, this year to produce double-digit returns in all equities. We had that last year. But we are expecting a very strong economy. And the piece of this, again, that was really beaten down, if you think about profits across the economy, the small business sector has really taken a terrible hit. Marginal companies just holding on again and requiring an insurance policy from the government to get them through this particular piece. But there were really depressed pieces, manufacturing, industrial activity last year, which are the direct beneficiary of the way the economy has evolved around COVID. In other words, goods purchases are incredibly strong, much higher levels than 2019, and we have to produce for them. So that's the initial stage of the profit recovery, and we have to invest enough and only enough, again, to keep doing that. The services sector will be the story of much greater strength in profits in 2022. And some of the things that we think about are raging strong now will actually come down a bit. that will change a lot of things across the world, including some regional strength.
Given how the consensus seems to be building that the economy has a greater chance of overheating or going too fast or going faster rather than too slow, what's the ballast in your portfolio? What's your sort of solid, steady asset that's going to keep you going regardless of what happens?
Great question. So there are things that we're doing that just evolve the portfolio because markets, again, are always ahead of the economy. So some of the things that we've done, for example, were to take an overweight in U.S. small cap since April of last year, and the past month shift that out into global healthcare. It seems like an early time in the cycle to go from, a cyclical recovery play, right, to a long-term outperformer. But the way it's happened, we've aggressively priced U.S. small caps for recovery. I don't think that they've really gone too far. I would expect some further returns and some further gains this year. But you're essentially trading up for something that is, instead of the hare is the tortoise.
Steve, I don't mean to interrupt, but we just had a headline come out which completely describes the overheating you're talking about. Quickly here, John Deere lifts net income up to a top $5 billion from a previous top $4 billion. That's going to permeate through the entire system. It's 6% GDP, isn't it?
Well, you think about this before infrastructure spending bill, potentially these sorts of things. I mean, that part of the economy, and not to say that John Deere is the perfect match for that, but this is going to be really strong this year before we have really put down COVID. And then when you were talking earlier about Janet Yellen's comments, these are true as well. Again, we've dropped employment by nearly 10 million with a 1 million increase in the size of the adult population over the past year. There's another piece of the economy that's extremely depressed. And if you take a look at it in the aggregate, we could take a look at consumer prices, we could take a look at commodity prices. The commodity prices are raging for the goods sector. But if you take a look at hotel pricing, it's falling very, very rapidly right in this period until we get past COVID. Then we can broaden out the recovery. I think we probably will see, and this is very early to say this though, some of the things that have been very strong, home electronics, shipments from Asia, these sorts of things were one-off purchases that won't be repeated in 2022.
Steve, great to catch up. Steve Whiting of Citi Private Bank's Chief Investment Strategist and Chief Economist. From New York, coming up shortly, Ellen Zentner of Morgan Stanley. This is Bloomberg.
In New York with the First Word News, I'm Karina Mitchell. The U.S. says it's willing to meet with Iran to restore the nuclear deal. Iran says not so fast. It wants the U.S. to first rejoin the 2015 agreement and lift sanctions before any talks. Donald Trump pulled the U.S. out of the deal in 2018. He also imposed sanctions that hammered Iran's economy and infuriated other world leaders. Meanwhile, Republican Senator Ted Cruz is back in Texas after a highly criticized family trip to Cancun, Mexico. Cruz jetted off while Texas was dealing with widespread power outages. He then said he did it because his daughters were cold, but says clearly it was a big mistake. Over to the UK now. Chancellor of the Exchequer Rishi Sunak plans to delay consideration of an online sales tax till the fall. Bloomberg's learned that because of the economic uncertainty due to the pandemic, the proposal aims at making sure bricks and mortar stores aren't at a disadvantage to online retailers. And in the UK, a landmark court decision that threatens Uber's business model there. The Supreme Court says that Uber drivers are workers entitled to rights like a minimum wage, holiday pay, and rest breaks. The ruling is the end of the road for Uber's 5-year fight over the status of its drivers in the UK. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
país, igual que los demás países del mundo, no están preparados para esta pandemia. Más aún, los más afectados son los países de desarrollo como el nuestro, ¿no?
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Many Americans feel that the system is stacked against them, and no matter what, Wall Street always wins. In this instance, many retail investors appeared motivated by a desire to beat Wall Street at its own game.
I'm personally humbled by what happened in January. Investors in Melbourne suffered significant losses. It is now our job to earn it back, and I'm taking steps to protect our investors from anything like this happening in the future.
We don't answer to hedge funds. We serve the millions of small investors who use our platform every day to invest.
That's a snapshot from hearings into the GameStop rout. House Financial Services Committee Chair Maxine Waters, Mavin Capital Management CEO Gabriel Plotkin, and Robert Hood Markets CEO Vlad Tenev. I am not a cat. That was literally the highlight of the whole thing in the hearing.
Pretty much.
Just yesterday. That was it. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Let's check out the price action this Friday morning. Good morning to you all. We look like this. We're up 7, call it 8 on the S&P. Back through 3,900 after a break of it yesterday briefly, up 0.2%. In the bond market, yields are higher by a single basis point, back through 130 again, 130.59 on a US 10-year. And in the FX market, dollar weaker against all of G10, euro dollar 121.40. Tom Keene, cable, perfectly timed. There we are, back at 140 John, on a session.
I'm sorry, we have to pause, folks. On cable 140, I think 2018. Before that, the last time cable was at 140, John Farrell was working a 14-hour day at Queen Victoria Street, and I was in a hotel bar in Mayfair resting over the Brexit scare. I mean, John, you and I remember a 140
You're
sterling.
so inebriated, you forget we weren't at QVS, we were at Citygate House.
That's true.
Because we hadn't moved into the new building, Tom. But yes, it's been a massive turnaround, and I think the vaccine rollout in the UK has really surprised people to the upside to such a degree that they're willing to look through a really ugly resale sales print earlier this morning in the UK.
And you're seeing it across the Bloomberg terminal here, across all our asset classes. Let's look at some of the enthusiasms in Washington as well. Emily Wilkins joins us, Bloomberg government reporter. Emily, it's about the president, it's about Pfizer, and it's about vaccine success or not. Does the president visit Pfizer today with a message of success, or let's get going?
Well, so far,
the vaccine rollout that we have seen has been meeting all of the requirements that Biden put forward on the campaign trail. In fact, if you remember, Biden initially said that he wanted 1 million vaccines per day for the first 100 days. They've now raised that up to 1.5 million per day. And it's even going higher. At this point, the average amount of vaccines that are being distributed in the U.S. is over 1.6 million per day. So at this point, you can talk about victory, but I think Biden is also thinking about other things at this point, including equity, who's getting the shots, in what order do the shots need to go out there. These are all big discussions that are beginning to break through in his administration.
I look, Emily, where we are, and I'm looking sort of at a Friday. We know the honeymoon's over. There's lots of posturing, including headlines this morning from Mr. Biden. We're in action. What's the action now? Is it messaging or is it tangible?
I think it's a little bit of both. I mean,
Fair.
definitely
Okay.
the White House and President Biden want to make sure that they are having the message to Americans. You need to wear your mask. You need to keep being safe. That's certainly the message that Biden had earlier this week at a town hall. But it's also the tangible things that the federal government can do, such as implementing the Defense Production Act, which is going to increase more vaccines, and also sort of look at where these vaccines are going. I mean, one big debate Biden's had to engage in is exactly what's going to happen with the reopenings of schools. What standards are going to be out there? What is the federal government going to advocate and push for?
Prime Minister Boris Johnson is under pressure in the UK to outline how they're going to reopen. And I imagine that the president will be a victim of his own success going forward too. He's going to have to do the same. And Emily, I keep hearing the same word, Christmas. I keep hearing Christmas from this administration. And everyone I see reply to that tweet or whatever it is saying the same thing. Christmas, really? We've got to wait until Christmas? What are people saying?
Well, we have heard Christmas. I've also heard a potential Christmas in July. I mean, remember, President Biden did come out and say that there should be enough vaccines in the U.S. to vaccinate all U.S. adults by the end of July. That's a deadline that we've heard a couple times. Of course, having the vaccines does not mean that the vaccines have been distributed or actually given to individuals. And so I think there are still a lot of questions about exactly how this rollout process is going to work. How are people going to get the vaccines? In what order, and are the people who really need them getting them?
Meanwhile, given all of this that has to do with reopening the economy as well as giving support to it, it's interesting timing for President Biden to come out and say he's open to renegotiating a nuclear deal with Iran. This has created some pushback. Iran snubbing President Biden, saying that he has to lift sanctions first and re-enter the 2015 deal before they even talk. Could you just explain a little bit about the thinking of the timing here?
Sure. So I think the Biden administration is working on several different things. I think one big difference that we're seeing between President Biden and former President Trump is their willingness to engage